What's happening on Wall Street?
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
What was the cause of the United States Civil War?
Well, don't come with an easy question or anything. I mean, I think the cause of the Civil War was basically how government was going to run, the freedoms and what people could and couldn't do.
Thank you. And in the year 2023, it's astonishing to me that you answer that question without mentioning the word slavery.
What do you want me to say about slavery?
No, you've answered my question. Thank you.
That, of course, was Republican presidential candidate Nikki Haley speaking at a town hall in New Hampshire, responding to a question from a voter about the cause of the U.S. Civil War. The voter stunned when Haley didn't use the word slavery in her response. The first GOP contest is in Iowa on January 5th. Welcome back, everybody. Of course, this is Bloomberg Surveillance. Carol Massar, along with Katie Greifeld and Manus Cranny. Let's do a market check, although I've got to feel like markets are going to be...
Got a nice
Does nobody want to touch that?
It's yours, Carol, all yours.
Markets are going to be thinking about these presidential candidates, or will they? Will they care about something like that? On this Thursday, though, with 2 trading days left in 2024 here in the United States, S&P 500 futures are flat, 48.33. Crude, I do want to bring your attention to it because it continues to move to the downside. We've talked about the war trade, about concerns about the Middle East. New York crude, 73.27, 84 cents to the downside, and that 10-year 381. As we said, we haven't seen days where we're seeing the yield tick up a little bit higher there, but we're certainly seeing it. But I do think about politics, geopolitics, which is why we talk about crude a lot this week. Whether it's going to be those November elections, the world is watching our presidential election and these candidates. I will say Nikki Haley, in some of the debates that we've seen up to this point, certainly has a fair amount of knowledge when it comes to the global stage, and that, many would argue, is very timely, considering all of the pressures that are out there right now.
Well, if you look at the geopolitical stage at the moment, you've got half the sea containers routes of the world are in peril because of the Israel-Hamas war. You have a Congress that's incapacitated in terms of how to help in this hot war between Israel, Hamas, between Ukraine. There's still no funding. We're going to face off, literally face off those issues this week. So the American position on its international position, as it were, as the #1 ally and support is now very, very seriously in question. Therefore, it reduces Blinken's capacity and passport when he goes to the Middle East. That was one of the lines from one of our guests yesterday. That is not to say that America is dissipated in its function. It's just how the world perceives America.
Yeah, exactly. I will point out the Biden administration did announce yesterday $250 million in weapons and equipment for Ukraine. So it's final package of the year. I know, just squeezing.
It's nowhere near what they need, is it?
No,
really?
Exactly. And officials are pressing Congress to renew that aid in the new year. All right, so a lot to get to with James Lucier. He is senior political analyst at Capital Alpha Partners, joining us on this Thursday. James, nice to have you here with us. When you look at the situation in the Middle East, Department of State here in the United States, Antony Blinken getting ready to go overseas, trying to create some calm or find some resolution when it comes to what's going on in the Middle East. How are you sizing up the situation on this Thursday?
Well, I think people around the world are looking for decisive action from the U.S., but that's not really President Biden's style. He's more of a process manager. And he has a terrific national security team consisting of Antony Blinken and Jake Sullivan, but they're also process guys. And I think that what the world needs now is a sort of decisive signal that the United States is going to break out of this steady as we go path with Ukraine, and also our steady as we go try to maintain some semblance of restraint in Israel, and just choose a side one way or the other and start moving.
Well, what is it that takes, good morning, James, what is it that takes the White House to shift? Blinken goes on this trip. It's his fourth to the Middle East. It's his fifth to Israel. And our guests this week have said that his hand is not very strong when it comes to negotiating with Bibi Netanyahu because of this delay, and it may well be overcome this month, this delay in funding. Is the U.S. In a less powerful position to push Netanyahu at this juncture?
Well, I think the United States is absolutely in a less powerful position to push Netanyahu because we can't pass the funding either for Israel or Ukraine. I do think, actually, that we'll get that funding passed about the middle of next month. But you also have to look at the situation on the ground in Israel, where you have a rare unanimity among the political elites in Israel that they want to prosecute the war, they want to finish it. They're really past caring what the world thinks of them. And I think the Biden administration overestimates the amount of leverage they have because they really aren't as linked to the Israeli political situation as they could be, or they're trying to run the world from Washington and not from Tel Aviv.
Well, James, bring this conversation to, of course, the 2024 presidential election, because you think about Biden, the candidate, trying to handle this fraught geopolitical landscape. You have two hot wars going on in the world right now. How does that play into the voting booth? Will American voters be voting on geopolitical issues or more concerned about the U.S. economy and domestic issues?
Well, I'd point out that you have two hot wars and a border crisis going on, and Anthony Blinken obviously was in Mexico yesterday. I think a key move for the Biden administration is to come up with some sort of border deal, not to send Blinken to Mexico, but to send Joe Biden himself to Capitol Hill to cut a deal on some sort of border arrangement and thus release the funding for Ukraine and Israel. That's really key to the equation. Now, in terms of geopolitics, people are voting geopolitics. They're voting geopolitics perhaps in the state of Michigan. President Biden has got a significant problem with younger generation voters. Part of this is due to the economy and inflation, but a big part of it, too, is this perception that, Gaza is a humanitarian catastrophe, as in fact it is. But this is hurting Biden very badly with younger voters and swing votes in key states like Michigan. So the presidential election is very well going to be influenced by events in Israel and what Biden does.
So, James, what are you telling some of your clients and your customers in terms of the outcome come November here in the United States for the election?
Well, I spent most of last year telling people that I was really skeptical the candidate would be Donald Trump on the Republican side. I didn't think Biden would run again or would last again, but clearly we do have a Trump-Biden dichotomy. And the reality is that if you look at the swing state polls, it's not only closely matched, but probably Donald Trump might be the favored candidate to win, given his strong and intense support and Biden's rather shaky support. Now, I'm not sure that's how things shake out at the end of the day. I hope it doesn't. But, we're definitely going to be in a different type of presidential race here. I think that the Supreme Court and its role in deciding whether or not Donald Trump stays in the ballot, its role in deciding how the trials of Donald Trump proceed, that's going to play a very high role in the election.
James,
and,
very briefly, you also advise on energy and energy policy and climate policy in Washington. And to that end, I'm curious, record U.S. oil production, record U.S. exports. So does it matter who wins the White House next year for big oil? How are you advising them? Because Trump himself says, drill, drill, drill. And obviously, big oil's done well under Biden. Briefly, what are you saying to the oil?
Well, it does matter because we're talking about the energy transition and how many years the U.S. oil and gas industry has left. There's no question they would have a longer period of time to operate under a different president. There's no question that we have record output this year, but given oil prices, that output probably would have been even greater if we hadn't had the Biden administration's policies to grind down U.S. production. So, I think that on the whole, the oil and gas industry is going to be doing very well for quite some time. Tighter supply means higher prices. That sure makes it big.
Well, yep, that makes a lot of sense. But bottom line, a lot when it comes to politics domestically as well as globally. Yeah. But some great thoughts in terms of what it means for energy specifically. Hey, James, thank you so much. James Lucier of Capital Alpha Partners joining us here on Bloomberg Surveillance. All right, everybody, coming up next, we're going to check in with Jeff Yu of BNY Mellon on the European bond market. Really, as we've been saying, one of our big headlines, global bonds on track for their best 2-month gain on record. So what happens in 2024? We're watching global central banks. Who moves first? Who cuts first? Who is more aggressive? A lot to talk about. Don't go anywhere. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right. So
it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. From New York City for our audiences worldwide, this is Bloomberg Surveillance live on Bloomberg Television and Radio, alongside Manus Cranney and Katie Greifeld.
I'm Carol Masser. It is Thursday, 2 more days of trading here in the United States. Let's get you set up on this Thursday in terms of the market trade. Again, I feel like a broken record, but S&P 500 futures not at a record. Didn't close at a record yesterday, but we're kind of close. Hard to say whether or not we'll get there. 48.32 on those futures, just down, call it unchanged, just down about 0.75. NASDAQ 100 futures, though, a little bit of strength there, 0.2%, but nonetheless, some momentum when it comes to the tech trade. Russell 2000, which was the outperformer in yesterday's trade, outperforming those bigger caps. Are you yawning?
I'm sorry, you're.
Oh my God, she's yawning.
You're talking about small caps. I was thinking about how tired the
You're
small
going to get invigorated about the Russell 2000 next year.
You yawn. You hold on. Let's go back to the boards. Do you want to bring up treasuries and see what's going on there? Because we did see some upward momentum.
I could get excited about this.
All right, she's not yawning anymore. 4.25 is the 2-year note. We've got that 10-year note up slightly to 2 basis points. 3.81. And you've got that 30-year at 3.97. So obviously key when we think about what's going on in the mortgage market.
The whole curve is under 4%. That is exciting.
Yeah.
Just wait for the banks to come off the price. They're pricing mortgages at 8%. I was with a friend yesterday looking at property in Midtown, okay? Not me, he was.
You can say it.
8%.
You're among friends.
You're among friends.
Come on.
It wasn't my budget, I assure
Share
you.
a little.
I don't even have a credit history in this country, for goodness sake. I've got a Bank of America card, that's it.
We'll vouch for you.
8%. 8%.
Yeah.
And what's amazing is the limitation of products that are available.
Yes.
It's fix and bust unless you go to an alternative bank. Anyway, we're not supposed to be talking about rates,
if you can't buy an apartment, maybe you could buy an Apple Watch, because it turns out you actually can now. Let's get to some of the other headlines. Under surveillance on this Thursday morning, Apple resuming sales of its smartwatches after the U.S. Court of Appeals lifted the ban while the company seeks to overturn the decision. Now, Apple was found to have infringed on 2 Masimo patents relating to its blood oxygen sensor, but says a new software update mitigates the issue. A decision on whether that update will be deemed adequate is due January 12th, so another deadline to watch. Apple shares just up 0.3%.
So the watches, they will be back on shelves beginning Wednesday at some of Apple's about 270 retail locations across the country. Wider availability by Saturday. So I don't know, maybe buy them quick if you really want to buy one.
I wonder if there's going to be a rush. Like all of a sudden you're going to get like a pop and Apple's going to be like, everybody's buying.
A collector's item? I don't know. What happens here?
No.
Well, if you are concerned that this is going to...
Oh, you mean
don't forget, there's alternative products. She's got the alternative product on her arm. I don't think we're allowed to say what products they are. I think what's interesting is that the White House has sort of backed off a little bit on this. Catherine Tai on Tuesday that she wouldn't intervene, and the White House refused to veto the measure, and so that's sort of standing back from it. Of course, we've had a valuation this week. We've had Wedbush Securities on the show talking about a $4 trillion valuation.
Not worried.
And very bullish on China. The China bears on China have, in his words, been very, very wrong. Dan Ives. So it's get your bulls out for Apple.
Full ball. You mentioned China.
We should get a little bull.
Let's talk about Chinese housing. We just talked about it with one of our guests. The slump in China's housing construction set to continue into 2024, which jives with what she had to say. This, though, is coming from analysts over at Goldman Sachs, Morgan Stanley, and a few other banks. That would leave China with 3 straight years of contraction. The analysts are citing declining real estate sales, leaving developers with less incentive to start construction as a key reason. Yeah, who wants to build into this market? Yeah, it's rough. It's the one thing, not the only one thing, but a major thing over in China that officials really haven't been able to kind of resolve.
It's been a huge store of wealth. It's been the propagation. Under Xi, there was this magnificent empowerment of the middle class. If you look at real estate investment, it's down 8% in the first 11 months of this year. And for the whole of last year, there was a drop of 8.4%. So that just gives you a sense. I mean, you see images of these ghost towns, you see images of these cities, you see other networks gone out there and they've done the sort of investigation. So it's about middle class wealth.
And I mean, it's interesting that even though you've had this drip of stimulus trying to rather arrest this decline, it hasn't been successful at this point. I don't know what the inflection point is for China, but I'm sure the global investment community would love to know.
But definitely a drag and continues to be one. All right, one more for you, the global debt market. Wait, did we say this? Yes, we did. It's on track to post its biggest two-month gain on record as traders ramp up expectations for rate cuts in 2024. Bloomberg's global aggregate total return index lifting nearly 10% in the past 2 months, with recession risks underscoring the case to own bonds. What I will say is I do feel like from the conversations we've been having this week is that people are kind of pulling back a little bit maybe on those aggressive moves, but at the same time I also feel like there's a little bit of momentum that, hey folks, it might not ultimately be a soft landing and maybe the Fed's going to have to be more aggressive. What, you know, and when we hear those positions, what does that tell us about the outlook? Should we be a little bit worried?
It really feels like the writing is on the wall, because in both cases, you still have the Fed, you still have global central banks cutting rates, and you translate that into, you know, the global curves, and people are bidding for duration here. Even though you do have some central banks, I'm thinking about the ECB, et cetera, pushing back against those expectations, hasn't been landing.
Well, Lagarde tried to push back on, you know, we're not going to cut that soon and that early, and that was pushed back against. The view in the market is 175 basis points from the ECB. So that is more than the Fed and more than the Bank of England. So it's he or she who cuts first wins the race.
It's a race that none of them want to win.
None of them want to win.
I know, it's amazing to watch.
But just remember, if you know you've got global central banks cutting aggressively, what does that say about economic growth, the underlying growth fundamentals? Like, how worried do we need to be?
On the buy side, they tell us it doesn't matter.
Yeah, it always matters, doesn't it? All right, good guess we've got to get to. Jeff Yu is Senior Market Strategist over at BNY Mellon. We do want to talk about what we're seeing when it comes to this global bond market rally. Jeff, does it continue into 2024?
Well, broadly, looking at the easing cycle, I guess bonds will do well. You know, we're seeing an underlying flows that people are going into duration. But has too much been priced in too soon? I would say for the Fed, yes. I would say for the ECB, no. So going back to your point about Madame Lagarde, you know, about Chair Powell, they're all pushing back against easing right now. I would just say these pushbacks, some are a bit more credible than others.
So they're pushing back. Lagarde is desperately pushing back. We're just showing some treasury yields at the moment across the world. We have this global bond market rally. So you say we're going to get more easing from the ECB than the market expects, because right now it's pricing in 175 basis points. So what do we get, and what does that do to duration in Europe?
I don't think it's about the amount of easing, it's more about timing. So they're pushing back about when they are easing. But I think market pricing of starting around March or the meeting after that, so the second or the third meeting, I think that is a credible view. And then we just go from there. But sticking with the ECB, you know, one other thing to look at in the context of duration, they announced more QT, you know, by unwinding the PEPP starting the second half of next year. Will they be in a position to actually execute that? And is the market going to be ready for supply, even though they do want duration right now? So quite a few moving parts at this point. So yes, there is a duration play heading into next year, but just to put things in context, so we saw like 3-4 standard deviation moves throughout December. It's going to be very hard to repeat that, you know, heading into January. So after a correction, yes, I think flows can head back in, but then the race that you mentioned, it truly begins, and I do think the Fed is going to be losing that race in terms of who cuts first.
Okay, so they're possibly going to have to go first and go earlier. Does that say something more malevolent about the scale of recession here in the United States of America? Thankfully, you've studied the Psalm rule. I haven't got the depth of quant knowledge.
Jeffrey, just for us, could you quiz Manus on it? Because that would be a lot of fun. No, I'm just kidding.
Well, actually, it indicates when global recessions
Yes, it does.
Look, Jeff, you're omniscient in this regard. Just run us through for our viewers. What is the Psalm rule? Why does it matter? And where is the worst shirt globally, recession-wise?
So looking at the strict definition, the 3-month moving average of the U3 unemployment rate in the US rises by 0.5 percentage points or more relative to the low during the last 12 months, right? So, you know, that's explicit definition there. So applying it to Europe, you know, which is, you know, what we're really focused on right now. Oddly enough, UK and Sweden really are not doing too well in that respect. The UK quite poorly, but just to put things into context, so this rule can also be satisfied if the prior employment levels or the prior unemployment rate was far too low. So if the labour market was excessively tight, which in fairness it had been in certain European economies, then you could have that push up as well. But overall, going back to the hard landing, soft landing push, I think the US definitely in the soft landing camp, but for Europe is a bit mix and match right now. Overall, I think we need to focus on the fiscal side in Europe. Can Germany get past this constitutional wrangle with regard to the budget? Because what you don't want is fiscal contraction into a cyclical downturn. But that, to be honest, is what Germany is looking at right now, and they really need to resolve it.
All right, I hope you guys wrote all that down because there is going to be a quiz.
I've got the printout here with yellow highlights on it, so don't say that I don't read the notes.
We're getting Claudia on the phone right now as we
Later
speak.
in the show, we'll all quiz each other. But Jeff, let's stay in Europe. I want to go back to what you said about basically the ECB's credibility, because obviously the market is pushing rate cuts. And just today, I thought it was interesting. You had Governing Council member Robert Holzman coming out and saying rate cuts in 2024, they aren't guaranteed. Of course, he's one of the most hawkish members there, but still this pushback that you're seeing from the ECB, it's just not landing. What does that say about the ECB's credibility here?
Well, if inflation data keeps on surprising to the downside, which it really has been over the last 2 or 3 prints, then your credibility is damaged. We saw it on the way up, right? Transitory all the time, and it turns out it wasn't transitory. So that's when you lose credibility. So the last thing central bankers anywhere right now want is to have lost some credibility on the way up, and you lose it on the way down as well. So this is where they need to be really attuned to right now. So I just question, what is euro-dollar doing up here? Yes, it is a Fed story, but can you justify having a very strong euro right now with the export environment very weak? You mentioned China being quite weak as well. And also we've seen a downturn in the labor market as well. You look at job openings in France and Germany, they finally started to soften heading into December. So that services element in Europe, which Madame Lagarde said had been holding European wages up, that seems to be coming off as well. Look at the PMIs. So again, it's really difficult to justify, based on the data, the hawkish rhetoric at this point.
All right, Jeff. So I'm going to go into Japan, Bank of Japan, right? We had some comments out from the governor saying that that the BOJ can reach a judgment on policy before complete wage figures from small and medium-sized figures come out. He did an interview with NHK. So how are you thinking about Japan, this policy of negative rates that has been in existence for so long? Do we start to see some kind of shift in 2024? Can they actually do it?
Yes, they will have to shift. They'll absolutely have to shift, and the yen is going to be very much part of that equation. We do see a material drop in dollar yen, so the yen is going to be one of the best performing currencies heading into next year. And also, let's just go back to what they're actually doing. So leaving the rhetoric aside, they're tweaking their bond purchases as well, leaving more scope for yields to go higher. So it is happening. They will do it at their own pace, judge it on data, judge it on wages, as you mentioned. But net, they know that importing inflation via a weaker yen, that doesn't work anymore. It is a problem, and it is going to be one of the tweaks, well, the major shifts heading into next year. And to be frank, Asia needs it as well. So on top of that, if the yen is allowed to strengthen, I think it will allow a lot of other central banks in Asia to let their currencies move a bit more as well, especially on the strengthening side, especially those still with a bit more inflation to worry about. But net, that's going to be the seminal story in APAC, of course, on top of whatever China does with respect to growth.
The two R's are going to define what happens to the dollar: recession and rates. Your call is a soft landing, and the market has 150, 160 basis points of rates cuts. The question I have for you then is, soft landing in the United States of America, is that short the dollar, sell the dollar on the rates, and a risk on narrative? Does that define a lower dollar 2024?
So on a trade-weighted basis, the dollar has absolutely peaked, right? But pick your dollar shorts carefully, and there's still plenty of opportunities for dollar long. So like euro-dollar, I think should be heading back to parity, given what I've just said about ECB easing timing, cuts, and the Fed's going to be later than that. So I certainly will not be short the dollar on the euro leg. Dollar versus Asia, just mentioned, probably the dollar's going to soften a bit as well. Also, on a trade-weighted basis, one of the two most important trading partners for the US, closer to home, Canada and Mex. Those are going to be very, very interesting pairs as well. And I do think Latin American carry trades, they've run their course. Bank of Mexico going to start easing rates. So the dollar can pretty much hold its own, maybe against Canadian dollar and the Mexican peso. And that is going to be material for US financial conditions as well, especially for the exporters.
Jeff, you're a rock star. Thank you so much. Really appreciate it. And Happy New Year. Jeff Yu of BNY Mellon joining us on this, not Wednesday, it's Thursday, everybody. I know. It's one of those weeks. Hey, listen.
Having so much fun with this.
Coming up at 7:30 a.m., Kathy Wood of ARK Invest. See what she has to say as the NASDAQ is set for its best year since 1999.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Tottenham are enjoying a strong season in the English Premier League, sitting in 4th place despite changing their coach prior to the campaign and selling their best player. Bloomberg's Jonathan Farrow sat down with Tottenham's chairman, Daniel Levy, and to talk about the big issue: the influx of Saudi money into football, the future of the club, and the sale of Harry Kane to Bayern Munich.
So Harry was willing to stay, but he wasn't willing this summer to sign a new contract. He didn't say that to me that he wanted to leave. He didn't say that he would never sign a new contract, but he wouldn't commit this summer. And of course, we were in a very difficult position, had 1 year on his contract. And as a club, as I said, we're self-sufficient. We couldn't live in a dream that he would sign a contract. We had no guarantee, and therefore, when Bayern Munich came along, he was willing to go to Bayern Munich, and we agreed a deal.
You've since disclosed there is a buyback clause. That's getting a lot of attention and a lot of fans excited. Can we talk about the terms of that buyback clause? What is it?
If I'm honest, I think the actual precise detail of the contract with Bayern Munich should remain confidential. All I would say is if Harry one day wants to come back to the Premier League and he wants to come to Tottenham, we would have the ability to purchase him.
We've talked a lot about Saudi Arabia and the disruption in this summer transfer window, not just for English football, but for the whole of European football. Are you getting players knocking the door now saying, I've seen Neymar's contract in the newspaper and I want a slice of that? Does this change things for you?
I think you have to look at the Saudi Arabia situation as, it gave a huge influx of money into the market. The market is particularly tough outside of the UK at the moment. And I don't see that what's happening in Saudi Arabia is going to have any direct bearing in terms of player contracts in Europe.
What do you expect it will change?
Well, it's another market for players to look to. Not every player will want to go to Saudi Arabia, but just as not every player wants to go to Germany or France or wherever.
Joe Lewis has got his own legal problems. He's transferred his holding of the football club to Family Trust. We understand that dynamic and how things have changed in the last couple of years on that front. Technically, that means you no longer have that big billionaire backer. Do you need one to succeed? Is that something that Tottenham needs?
Well, firstly, the ownership of Tottenham has been of no relevance to the operations of Tottenham for the last 20 plus years. It's always been self-sufficient. As far as very wealthy people owning football clubs, as I said, the new rules now are going to be engineered to such an extent that hopefully you don't need to be a very wealthy owner in order to have a successful club.
Would you be open to selling a stake?
My answer to that question has always been the same for 23 years. We have 30,000 shareholders who own approximately 13.5%. We run this club as if it's a public company. If anyone wants to make a serious proposition to the board of Tottenham, we will consider it along with our advisors. And if we felt it was in the interest of the club, we would be open to anything.
Has anyone made an offer?
Over the years, many people have made offers, but there's never been an offer that's been...
Well, give us an idea of what those offers have looked like. Where have they come from?
All parts of the world. The Far East, the Middle East, America. But nothing has been put on our table that we felt has been in the interest of shareholders.
The stadium's been a big project for you, and clearly that's right for the club, and other people are starting to copy you as well. How big of an initiative has that been for Tottenham Football Club, and how do you think it's going to really underpin the success in not just years to come, but potentially decades?
I think people don't realise how big a project building a stadium is. That project took us probably about 17, 18 years from start to finish. I think you've got to take a very, very long-term view. I think that it obviously has a major impact on the club, positive and negative, because you don't build a stadium for nothing.
A multi-purpose stadium as well. It's not just about football anymore, is it? It's music, concerts. It's about everything else and all above.
Well, that was done for two reasons. One is, when you look at the cost of building a stadium, you're talking about such huge sums of money. In our case, it was £1.25 billion. I think today it would be over £2 billion.
Wow.
And you have to find ways of paying for that asset. And just having football games is not enough of income to generate.
What does music bring in, Daniel? Give me an idea of what a Taylor Swift, Beyonce music concert brings in for Tottenham. How much money can you make from something like that?
Well, every concert's different. So it's not just concerts, it's boxing, rugby, all sorts of events. You're not going to justify spending the money by all those other events. What they do, though, they make a contribution to the capital cost. I would say that, over a 4 year, we may make £20-30 million of additional revenue as a result of it.
And what's the gate receipts look like just in terms of football over a season? How does that compare? How does that stack up?
Well, our gate receipts now are over £100 million.
Big Ange has come after Antonio Conte and Jose Mourinho. Can we talk about dealing with difficult characters? What was it like dealing with Antonio Conte near the end?
I had a good relationship with both Jose and Antonio. They're different, and as I said to my fan forum last night, I said to them, I made a mistake. Right? They are great managers. They were just not right for this club, and the way they want to win is different, really, for how we need to win.
What does that mean? They're proven winners. They've won before. What does that mean?
I think there's a couple of things. I think our style of football that our fans crave for is we want attacking football. And if that means winning 4-3, then so be it. Whereas I think their style of football is, they don't mind being defensive and winning 1-0. And we were in a situation where we were so desperate to win. I think at that moment in time, when I go back, 4 or 5 years ago, I think we would have taken any way of winning. But we didn't win. And therefore, when you don't win, you get a very disgruntled fan base with our fans.
Where did the pressure come from to begin with to hire names like that? I was listening to the recent fan forum you did, and you mentioned that certain players wanted a certain kind of manager. You alluded to that. I'm paraphrasing to some extent. Were there certain players that wanted that kind of name? Jose Mourinho and Antonio Conte? Do they come and knock the door and ask for that?
And it wasn't about the name. It was about they wanted to win just as much as I did. And then we'd come so close with Maurizio, who was a great manager, and he did fantastic things for this football club. And we got frustrated, and I think we went through a phase where we said, well, let's try something different, and it didn't work.
Define success for this season. Let's finish there. What is success for you this year?
That's a difficult one for me to answer, because I think I'd be putting unfair pressure on my new coach. Honestly, I think for us, though, we want to play football where we're entertained. We want to come to a game where we're looking forward to coming to a game, where we believe we have a really good chance of winning. We just want to entertain our fans.
Entertain and win?
Of course, win, but win with style.
Winning with style. There you go. Great conversation between Jonathan and the Tottenham Hotspur chairman, Daniel Levy, having bids from all parts of the world in that conversation with Jonathan. So, ladies,
he wasn't having too much fun.
Listen, he got a trip to London for a whole week. I don't know. I can't remember why they were there, but it was a good conversation.
It was a great conversation.
When it comes to the money that flows around the world, there's no doubt about it. The region that I've just left, which is the UAE and Saudi Arabia, they are voracious in terms of buying English football clubs and buying star players. Saudi Arabia spent $875 million in the transfer window. I mean, that's number 2 to the English clubs. So it just shows you the names, perhaps at the end of their career. Take the money, honey.
I was just looking overnight, too, last 20 hours, Tottenham personally telling about 3 senior stars that they can leave the club. I know the January transfer, I guess, coming up. So this happens among the players.
Yeah. Strategically encouraged to reconsider the direction of their career.
I always love when that happens.
I have to say, in prepping for this show, I did a lot of macro research. I learned a lot about politics, etc. I didn't expect to have to brush up so much on football.
Just watch the documentary.
Or soccer. Yeah,
well, it's Ronaldo. Look at Ronaldo. He went to Saudi Arabia. He got
Yeah.
special dispensation in terms of how he lives, how his lifestyle is, which takes us to one of the other, and we'll talk about this story a little bit later on. There's one of the big, sovereign wealth funds in the world has decided to trim some of their exposure to Saudi and to other Gulf nations because of a whole host of reasons, not least because of human rights. So that, there's lots of different pros and cons with now is the time to invest in Saudi.
Yeah, I think it's interesting. Listen, there's so much money in sports, whether it's football, whether it's, football overseas, globally, football here in the United States, and you see it, whether it's the streaming folks, whether it's traditional linear television and broadcast, but that is where there's an awful lot of money, and it makes sense that you see a lot of attention being paid to it, and a lot of folks paying up big time, whether it's for players or for teams. All right. We're going to shift away a little bit from sports, but coming up next, we've got Sonia Martin of DZ Bank getting her thoughts on certainly the environment when it comes to 2024. She's coming up in just a moment. Stay with us. This is Surveillance, and this is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Key to 2024 is to be well diversified.
At this point, you're really trying to time it, right, to wait for any increase in rates.
Policy normalization that we see and slowing in the economy is going to be a boon for the duration trade in 2024.
In the last 4 to 5 weeks, risk on is now taking precedence over risk off.
This rally that we're seeing now, is sort of the pain trade in evidence. I've been calling it weaponized FOMO.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide. A very good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside my cohort, Carol Masser and Katie Greifeld. I'm Manish Kranny. A very good morning to you. Double nickel. It's a phrase that we use when you put a futures order in. 55%, that is. That's what the NASDAQ has done. 55% this year. Don't get the order wrong. Don't screw it up. And that is set for the best year since 1999. Where was I in 1999? Trading bonds badly.
You weren't buying like pets.com and things like that?
I don't think we even had the internet then. I had a Bloomberg terminal. I got my first Bloomberg terminal in 1992.
But it was the era where you just threw .com off of anything.
It
and
was.
people
It's
were
a bit like AI.
let's buy. Well, is it though? I would say that the tech trade that we've seen is much more logical. Different. And I do feel like whether it's through social media and so on and so forth, that investments get smacked down or stories get smacked down pretty quickly and play out in the markets versus maybe way back then.
Well, I feel like when it comes to the story around AI, there's so many comparisons to the tech bubble, but also to the internet, that maybe this is as promising as the internet was. And, I wasn't, really paying attention to the markets in 1999, but I do think sometimes about
Thanks, Katie.
The horrible
You can
takes,
shut off her mic now.
But the horrible takes I would have about the internet, like I would have said, I'll never send an email, I'll just pick up the phone. So I try to keep an open mind when it comes to AI.
I think the interesting thing as far as technology is concerned, we've already had a couple of guests this week that are very, very bullish. We know that we've had Wedbush Securities talking about a $4 trillion valuation for Apple, but also referring to this moment in technological time, which is AI. It is the equivalent of what happened in 1995 when you had this technology revolution. You had Alan Greenspan talk about a paradigm shift in technology in the 90s. So are we set for something stellar in regards to productivity and in regards to the labor market? These are perhaps the issues that we need to debate.
Or the unknowns, right, at this point in terms of the magnitude of the impact that they ultimately have.
Absolutely.
Or it has.
And also, when does it actually translate into profits for some of these companies? Because so far, it seems like AI, of course, there could be...
For NVIDIA, it's working out.
It's working out for them. They're sort of the picks and shovels of it. But you think about the companies that are spending really billions and billions of dollars on research near term, that seems like a little bit of a margin pincher, but maybe for that great promise.
Well, of course, the other big narrative that we have is the bond market, a global bond market rally, which is lit up. And we've had Jeffrey Yu warn us that a great deal of the rally has already been priced in, but it is a global momentum, and that's the critical thing here.
And it'll be interesting to see where the floor is ultimately. I mean, you think of the 10-year Treasury yield, to bring it back to the U.S. briefly, just the fantastic moves we've seen there. Is 3% inevitable, or, maybe we've returned to 4%?
And a little bit of a reality check as I look at some of the most read stories in the past 60 minutes. Half of Red Sea container ship fleet avoiding the route after attack. So again, as we talk about the run-up that we see, this risk-on trade that we are seeing, whether it's in global bonds or whether we're talking about equities. We haven't really talked about crypto a lot in terms of the move up that we've seen in Bitcoin.
Don't worry, we've got a full package of crypto for you with Kathy Wood. She's going to be with us in just under 30 minutes, so we'll be able to talk crypto. But sorry, go ahead.
No, but it's a reminder that there's stuff going on, really serious stuff going on around the world, and we do still aren't quite sure when this comes to an end. If it expands, if we see a wider conflict in the Middle East, we talk about China and so on and so forth. There's just a lot out there.
Well, Antony Blinken is on his way to see what kind of passage forward can be negotiated. There's still hostage negotiations going on between the White House and the Emir of Qatar. We know that yesterday. No, not at all. There was a big give back in the oil market. Let's just check the markets for you this morning. A very good morning to you if you're joining us. It's a fairly flat-looking board for you this Thursday. S&P 500 yet to make that record high. Euro-dollar will return to parity. That's according to Jeffrey Yu. We've just had that conversation with him. He sees a much more aggressive, harder landing in Europe relative to the US. Pick your dollar short. That would be where Jeffrey Yu has recommended. Bonds, as we've just said, I mean, you're looking at the 2023 lows, just off those 2023 lows, 381. We dropped by 10 basis points yesterday. Fairly good, well-received auctions. My voice will last until the end of this market check. And oil dropped by 1.9% yesterday. We add to that momentum on the downside is an inventory build-up in Cushing. You're looking at that inventory build-up for 9 weeks in a row, which seems to be trumping the geopolitical concern in the markets. Let's bring in Sonia Martin, head of FX and monetary policy at DZ Bank, and see what she makes of these FX calls. Sonia, very good morning to you. The stage is set for a soft landing, we've been told in the past 2 hours, and a drop in the dollar. But the last guest that talked about the dollar suggested pick your dollar short very, very carefully. How do you see the trajectory for the dollar going forward into 2024? 170 basis points of rate cuts are in there. Is the dollar reflecting that already? Good morning.
Good morning. Yes, we have seen some incredibly volatile movements in the market of late, and I think it's likely that we're going to continue to see that as we enter into 2024. I was actually just looking at a chart of euro dollar for this year, and when you look at the ranges that we've been trading in, 105.457 in the lows, 113 or something in the highs, and we have really sort of fluctuated between people becoming very bullish, very bearish, parity calls, 120 calls, very much the similar what we've seen in the bond market. So I think we're going to see the same because, as you just mentioned, there's so many stories happening. There's, talk about rate cuts. There's the question of how severe the slowdown will be in the US, but also in the Eurozone. What's happening on the geopolitical stage? There is a lot in the mix for this year, a lot of uncertainty. And I love the fact that you've been using this term FOMO because it describes, I think, perfectly how investors have been rushing like mad in one direction, turned around and rushed into the other direction, within a matter of days sometimes.
Well, Sonia, do you see in terms of global central bank policy, is it going to be a race to the bottom in 2024 when it comes to cutting rates, or a little bit more tempered?
I think the current expectations are massively overdone. I mean, obviously, it all hinges upon, the further development of inflation. And, we're all celebrating the fact that inflation has come down, although, I mean, I don't know how it's for you guys. Personally, I don't really feel that things are getting cheaper. No. And they're not, let's face it. I mean, inflation at 3% seems great when you dealt with 10% a while ago, but 3% still means it's getting more expensive. It's just not getting expensive as fast as before, but it's not getting cheaper. And the problem is that this last mile on the inflation development is probably going to be quite sticky. So we're probably going to see a renewed pickup in inflation in early 2024. That should dampen rate cut expectation. I think central banks want to cut rates, obviously, but they won't be able to do that until the inflation has come down more significantly, and especially the core inflation rate has fallen. So I think it's going to be later than what the market is currently expecting, and therefore also not be as aggressive as what the market is currently pricing in.
So data dependent.
Data dependent. We've heard that one before. It will be fascinating to see that last mile of inflation play out. But let's talk a little bit more about the sort of rate differentials, expected rate differentials between the ECB and the Fed, because I think it's striking that you've seen the euro rise to the strongest level since July versus the dollar. Then you take a look at market expectations for the ECB to move more quickly and more aggressively than the Fed. How does that translate into the euro-dollar pair, especially against this strength that we've seen?
It doesn't really make sense, if we're being honest. I mean, it doesn't really fit together how this aggressive pricing of rate cuts should go hand in hand. In the Eurozone particularly, it goes hand in hand with the stronger euro. Of course, you could always argue the economy side, right? You can always argue that rate cuts are positive because they mean less pressure points on the economy, and that way you could argue that rate cuts are something currency positive. I mean, I've been in this business for more than 25 years. At this point, you can argue it either way, whatever story you want to and I think that's what the market is doing. I think the ECB isn't anywhere near as close to cutting rates, and they've been telling us this quite repetitively in recent months, but people aren't listening, and I think they won't listen until the data is there, and we are expecting inflation in the Eurozone to pick up again early in 2024. And I think when that happens, the narrative is going to change again. And as far as the euro-dollar move is concerned, I mean, let's not forget, this is Christmas now. It's between the years. It's really quiet. It's thin liquidity. I wouldn't put too much focus on what we're seeing today and the next couple of days, and wait for, sort of the second week of January.
Yeah, the second week of January. Maybe there's actually some volume and trading activity coming back into the market. But I want to talk about China because at the top of the show, we spoke to a contrarian bull on China, which was a very interesting conversation since sentiment there seems to be in the gutter. But you write in your notes that China will not be a positive story next year. If that's the case, what does that mean for Europe?
Well, I mean, as you correctly said, I mean, China is, in our view, definitely not a positive story. I mean, we have plenty of problems. The real estate sector is still very wobbly. We have a demographic issue. I mean, high debt levels. I mean, there's a lot of problems in China. So China does not provide any sort of growth impetus. And this is something we will feel quite keenly in Europe. Obviously, we have already a very weak economy. Obviously, Germany being particularly hard hit at the moment. But generally throughout Europe, we're having pretty weak growth. And we're not going to get a positive sort of kick from China. And that means that even though we are expecting things to pick up slightly in Europe, it will remain very anemic. We're not talking about solid growth because, honestly, where should it come from?
Let's just finish off briefly with the UK, because there was this moniker just before Christmas, stagnation nation. We've done the survey. Bloomberg talked to 52 economists. We're going to skirt that. It'll be 0.3% growth for next year. But if we're misunderstanding what the ECB is going to do, how mistaken are we in terms of what the Bank of England is going to do? Cable trades at 127.80. It's had a nice run. Does it endure?
No, I don't think so. I think, again, it seems overdone to me. I mean, it was early this year that we had, I keep getting mixed up with the years now, but I think it was early this year when this cable did really well for a while on the back of the fact that the UK economy wasn't doing as bad as expected. So I think we're seeing that again happening now. There's a sort of slightly positive surprise there, but inflation in the UK is still really high. And the Bank of England won't be able to cut rates anywhere as fast as the market is currently hoping. So same story here. And also then, therefore, sterling, definitely not a winner for 2024.
Okay, well, certainly Bailey and Lagarde have been hammering home that message, and that we are too presumptuous and too presuming of when and the size and the scale of rate cuts that we're going to get. Sonia, let's see what is delivered in 2024. We wish you a happy new year in advance. I'm sure we'll see you in 2024. Sonia Martin there of DZ Bank. And if you're just joining the program, let's check out what the markets are doing. You've got the S&P 500 at 48.33. That is flat, down 0.01%.
Yeah, unchanged. I'm going to do it. I'm going to go for you.
There we go.
Just for you.
It's interesting, Sonia's point about the ECB, which was we're not listening. We've all got like cloth ears. We're obsessed by 150 basis points of cuts, 160, 170, whatever. It changes each week in the US. Likewise in Europe. You're not going to get this scale of rate cuts. Inflation is going to be sticky, and therefore putting maybe a floor under that euro dollar that you have there. S&P futures are flat, but where the big trades seem to be is in FX. You've got Jeff calling parity on the euro dollar, which is the other side of that trade.
Yeah, and I love FX because it's really a zero-sum game. It's very easy to follow in that way. And I also keep going back to Jeff Yu's point that you keep bringing up, is that when you think about your dollar short, you have to be very careful there. You have to be very selective. Maybe it's not in Europe, but certainly you look around the world and there's plenty of opportunity.
And I would just say that I think it's interesting that we've seen in some of the guest notes and some of the conversations that the difference between what equity markets are telling us versus what the fixed income markets are telling us. And one of them is going to get it right. It's not the first time that we've seen this division, right, in terms of what market activity is showing us, but we'll see ultimately.
Yeah, you think about the pricing for the ECB and then you take a look at the euro strength against the dollar. It doesn't make a ton of sense right now.
Well, the debate is going to be, if you've got such a demise in rates in Germany, in the UK, and in the US, is it something much more malevolent in the economy? We're going to get some jobless numbers a little bit later on today. We've had the auctions. They've all gone very, very well throughout
In anticipation of those lower rates, right?
Absolutely. So front running our own optimism. Coming up, we're going to catch up with Isaac Boltanski, Director of Policy and Research at BTIG, right here on Bloomberg this Thursday morning. A very good morning.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Geopolitics. President Biden has got a significant problem with younger generation voters. Part of this is due to the economy and inflation, but a big part of it too is this perception that Gaza is a humanitarian catastrophe. So the presidential election is very well going to be influenced by events in Israel.
James Lucia, the senior political analyst over at Capital Alpha Partners. As we waken up to Antony Blinken setting forth to the Middle East on his trip, what is going to come from that? That's one of the big questions that we have. If you're just tuning in, it's gone 7:16 in New York. It's fairly flat on these markets. We've got a hint of green, Katie, 48.34, but still really the powerhouse is in the NASDAQ, up 55%, outperforming the S&P 500. Euro dollar, we've had today so far a call of parity on the show for the euro dollar next year, and we've also had a floor. Listen to Lagarde, she's not going to cut rates as aggressively as we all anticipate. That was from DZ Bank just there now, and 10-year yields just ticking up ever so slightly, 381.28.
Yeah.
That was after we broke 380 yesterday for the first time since July. So the size and scopes really look across asset classes, and it's pretty eye-popping.
It does feel like everybody's kind of squeezing in some gains, right, just before the end of the year. But it's just kind of limping towards it, it feels like, in some ways. I'm just curious how it sets up then for the new year.
Yep, and don't forget, we've got that one theme, which is all the money sitting on the sidelines, and where does that get invested into? Weaponized FOMO. We can come back to that with
we will.
We will. But geopolitics are front and center, and I think, as you have said through the morning, one of the most read stories on the Bloomberg terminal is about the amount of global trade that is potentially at risk because of the flare-up in the Red Sea and the issues from some of the proxies of Iran. Isaac Boltanski is the Director of Policy of Research over at BTIG. Isaac, a very good morning to you. We're setting the table for Blinken's visit to the Middle East. We just had one guest who said to us, look, Biden needs to pivot. He's now got a huge problem in terms of younger demographics in various swing states on his position on Israel. Does he have a growing political issue that could really challenge him as he goes into this election year in 2024 on the position of the Hamas-Israel war. Good morning.
Good morning. Look, I think that the White House is undoubtedly concerned with early polling numbers regarding young voters. And when you really look at that segment, the 18 to 29-year-old segment, you've seen real slippage of the president's support. You know, there are a number of polls, one that I continue to look at that focuses exclusively on key battleground states, the 7 states that will decide this election. And Biden's leading by 1 or 2 points at most in those battleground states. And so, look, there is undoubtedly a concern regarding these young voters. And it may be the Middle East, it may be student loans, it can be any number of things. But what I hear when I talk to Democrats, and this is something that I believe they're going to repeat to themselves for the foreseeable future, is it seems as though young voters dislike the Democratic Party on every day of the year except Election Day. And so it's very easy to extrapolate and expand on some of the disaffected dynamics in that younger voter segment. But when they actually get to the polls and when they're actually asked to pull a ballot, pull a lever supporting either Biden or Trump, which is what it looks like will be the likely matchup, Democrats still feel relatively comfortable that younger voters will show up.
Well, 2 things I wanted to ask you. I mean, how much are you betting that it is indeed another matchup between Biden and Trump? Having said that, also the outcome for President Biden, how important is it who he is ultimately running against come November?
Sure. Look, right now, I've found it interesting over the past few months, Democrat and Republican contacts. Democrats continue to say there's a chance President Biden will step back. Republican contacts continue to say, look, maybe there'll be support that coalesces around Nikki Haley or someone else who is ultimately able to overtake Trump.
As soon as she figures out that slavery was part of why we had a civil war. Actually, it was why we had a civil war. Yeah. But go ahead.
Well, Look, I'm just saying at this point, there's a fair amount of hopium coming from you know, the traditional bases of both parties. And the reality is when you look at the numbers and you look at the way that our primary system works, with a lot of these states being winner take all from a delegate perspective, you have to assume that it's Biden v. Trump. What I am most focused on, Carol, and I think what investors are going to have to remain cognizant of for the next year is the last election between Biden and Trump was decided by 44,000 people in 3 states. And so that's when we have to really start layering in how third-party candidates could impact the calculus for voters in key swing states.
I mean, I think we all as Americans care about the outcome because we are I'm looking at the Balance of Power newsletter this morning, risks of a new global war, talking about conflicts overlapping from West Africa through Ukraine to the Middle East, you know, this time in terms of maybe another global war, World War III perhaps, that it starts with a bang, you know, not with one big kind of incident, but several things kind of brewing around the world. And I think who ultimately is in the White House is going to be really important in facing a lot. So how do you think about kind of what kind of global situation, geopolitical situation we might all be facing come November?
Yeah, look, I think we need to be as humble as possible, right? No one in my seat was talking about a war in Israel 4 months ago, right? No one was talking about the Red Sea a month ago. And so we need to be humble in understanding that there are no clear mile markers on the road ahead from a geopolitical perspective. But we can understand how we as a country respond to those. And so that's been part of the struggle for the White House in getting an aid package together for Israel and Ukraine, which traditionally was pretty darn easy. Right, that's something that you would have seen cruise through with almost unanimous support just a few years ago, and so that has changed. So our ability to for politics to stop at the water's edge, which has been a driving force in the American ethos for years, has stopped. And right, so our own political dynamics have made it more difficult to have a unified international stance. And that makes it easier for others to rise, which is what you've seen with Saudi Arabia and its attempt to become a global power and others. And so to me, it's more of a focus of the domestic dynamics where our own governing problems, which I don't see getting any easier in the near term, make it harder for us to be the force that I think the world has grown accustomed to since World War II.
And Isaac, on that thought, I mean, in late November, you published a year-ahead look, and you sort of took a look at the winners and losers in this potential election. And I thought it was interesting that both in a Democratic White House and a Republican White House, you saw the defense sector as a winner. What does that say about the year ahead and, of course, the U.S. involvement on the global stage?
You know, Kay, there's this line in town, which is Democrats want a small military and they want to send it everywhere. Republicans want a big military and they don't want to send it anywhere. I think that that's something that is a truism that investors can really sink their teeth into, and that we will have continued spending on the defense side. We are going to have areas of flashpoints. We're also going to have continued spending on cybersecurity defense, which is something that, again, you can say is going to happen whether there's a Republican or a Democrat in the White House. And so defense area to me is one that is interesting because I do think it's relatively safe from the political volatility that we've seen in the past, given the world that we live in and given the defense dynamics that I think both parties have embraced over the past few months in particular.
As we go into 2024, Isaac, and this time next year, we're going to know who's in that White House, aren't we? So what is the risk?
Hope so.
I hope so
hopefully
too.
So yes, we don't necessarily want to rerun.
I remember all those broadcasts afterwards because we were still waiting for the outcome.
I think we were all up for a very, very long time, weren't we, over that 2-week period of time. But very briefly, what is the risk if there's a shift in the presidency that some of the big Biden policies, the Inflation Reduction Act, etc., get U-turned, changed, and does that have an impact at all?
Yeah, this is something that, again, we're trying to separate signal and noise for investors. The Inflation Reduction Act and its $400 billion in green energy tax credits is safe. You can say that with emphatic certainty. Even though former President Trump says that he wants to repeal it.
That's a very certain certainty.
It simply will not happen. And here's one reason why. Some studies have suggested that early dollar flows from the IRA have benefited Republican districts by and large. Almost 80% of the early dollars are going to red districts. And that's the brilliance of the IRA. They structured them as tax credits, and Republicans don't like getting rid of tax credits.
Not at all.
Reversing cuts.
Isaac, we got to cut it there. Thank you so much for being with us, finishing off with an issue on tax. She's up next, Queen of Tech, Kathy Wood.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For our audience worldwide, a very good morning. It's Bloomberg Surveillance live on Bloomberg TV, Bloomberg Radio. Alongside me, the crew, Carol Massa, Katie Greifeld, and a very warm welcome. I'm Manus Kranik. Snapshot of risk as we go to 7:29, nearly 7:30. We've got a little hint of green on the S&P 500. The NASDAQ up a quarter of 1%. Of course, it is the darling of the world. It's up 55%. The Magnificent Seven's performance in the back half was not as resplendent as it was in the first half relative to the indexes at all. Russell 2000 down by 0.2%. Roll it over. Have a look at the rest of the markets because you are looking at yields ticking higher ever so slightly. Very strong, robust bond market auctions throughout the past 24 hours. You're looking at a nice move down in 10-year bond yields, 2s, 5s, and 10s down by 10 basis points each. So the bond markets took the auctions quite well. Let's see how we go a little bit later on today. It's a global bond market rally, by the way. Global bond markets are up by 10%, double digit, in November and December. So there is a world beyond borders. That's state of play on the bond markets. Will we endure? And there you have the euro dollar. We have a call already from Jeffrey Yu this morning talking about parity. Be careful which dollar short you choose because parity is on the way, according to Jeffrey Yu. And our second guest at DZ Bank said, of course, Lagarde is right. Inflation will be sticky. They will not cut as aggressively as the market presumes. Snapshot of under surveillance this morning, 7:31. This is what we've got for you. We're waiting for data. Regional Fed Reserve banks are expecting the labor market to cool in 2024. The Philly Fed saying manufacturing employment expectations are at the weakest since 2009. According to the Dallas Fed, the number of Texas manufacturers expecting an increase in jobs is at the lowest level since the start of the pandemic. The final jobless claims, as I say, that piece of the slate will come for 2023 in about an hour's time. We will break that for you. Apple resumes the sale of its latest smartphone watches in the stores after an appeal court ruled on lifting a ban. The company is in a patent dispute with Massimo over the blood oxygen sensor. And Apple says the Watch Series 9 and Ultra 2 models will resume online sales by noon Pacific time. Now, one of Cathie Wood's ETFs is shaking up its Bitcoin-related holdings, according to Bloomberg. The ARK Next Generation Internet ETF sold all shares in Grayscale Bitcoin Trust while buying 4.3 million shares in ProShares Bitcoin Strategy ETF. Bitcoin is more than doubled this year on hopes that the SEC will approve that holy grail, the spot Bitcoin ETF in the coming weeks. We're waiting. Bated breath.
We are all waiting, and so is Cathie Wood, and she joins us on this Thursday. Cathie Wood, of course, founder, CEO, and CIO of ARK Invest. Cathie, Merry Christmas, Happy Holidays. So great to have you here. Let's start there with the news, because we do have this story on the Bloomberg. Tell us a little bit about this overhaul and your thinking when it comes to how you are thinking about the investment strategy for you guys specifically when it comes to crypto.
Sure, and Merry Christmas. Very happy to be here again, Carol, Katie, and Massive. So we're as optimistic about Bitcoin as we ever have been, but there are a few regulatory and tax uncertainties We had been waiting for the discount between GBTC and NAV to narrow. It was as high as 50% at one point last year when there was great uncertainty around all of the turmoil in crypto generally. And now it's single digit. And there are now other products out there that we can use to gain exposure to Bitcoin in this moment. And it's just a moment of uncertainty between now, we think, and January 8th to 10th, somewhere in that range, perhaps. But we, out of an abundance of caution, didn't want to take any risk.
And I mean, let's get a little bit specific here because we're talking about the ARK Next Generation Internet ETF. The ticker there is ARKW. And I think what caught a lot of people's attentions is that you completely sold down your remaining stake of the Grayscale Bitcoin Trust. Instead, on the same day, you bought into the ProShares Bitcoin Strategy ETF. Of course, that tracks Bitcoin futures. It doesn't actually hold the physical Bitcoin. Can you explain that shuffle? What was the thinking there?
Sure. A couple of things. First of all, BITO, the ProShares, is already approved. There's no regulatory uncertainty having to do with it. So we chose to maintain our exposure through BITO for the time being. And as I mentioned before, there are some tax and regulatory uncertainties still as part of this process. We don't know exactly who's going to be approved and whether they've met all the criteria that the SEC has put before us. We know we have, but we don't know if others, including GBTC, have. We just don't know. So again, out of an abundance of caution, and GBT's discount, again, it was as much as 50% relative to NAV. So not only have we enjoyed this year the run in Bitcoin itself, but we've had the nice closing of that discount. So it's been, double good news for us.
But you've talked about January 10th, Kathy, I think in another report. Is that possible, whether it's you or somebody else, in terms of the first spot Bitcoin ETF actually getting approval?
Well, we think the probabilities have gone up because the SEC has been highly engaged compared to what was happening before. Before, it was just denying approval. And we just kept putting our filing in again, try, dogged and determined. And so here we are. We think we're first in line, and that's why there is this January 10th deadline. But we like the idea that the SEC has been so engaged, and it's not just with us, it's others as well. We think a number of funds could be approved at the same time. And they've been asking not only one set of questions, but follow-up questions. And again, that's a very good sign.
Well, speaking of engagement, go ahead, please. No,
Yeah,
finish.
the last few questions have been very technical. And so more de rigueur, and you'd expect them to be asking these questions as we head toward an approval. Now, it's not 100% certain, and so we want to make that clear as well. This is the SEC, and we never know, what might happen along the way.
Regulators can be tricky, that's for sure. Hey, listen, you mentioned engagement. Let's talk about engagement with your funds overall, and especially the ARK Innovation Fund, up 72% year to date, easily outperforming some of the major market benchmarks, still down 65% from the high back in February of 2021. For you, though, a lot of critics. We bring up your name, we bring up ARK, and you have a lot of fans and you have a lot of critics. There's a lot of discussion. Does it feel, though, a little bit like a victory lap this year?
Well, we are very happy that a couple of things have happened. That this idea that interest rates were going to continue moving higher has been proven incorrect. And I think even the Fed, while there is that small possibility, even the Fed is now starting to talk about the other side of the interest rate move. And so I do believe all we've seen so far is a reaction to that macro phenomenon or judgment call. We went through our flagship strategy, and all of our strategies went through a very difficult time from February 21 through December of 22. as interest rates, first of all, were presumed to move up or forecasted to move up. And then when they did move up, so it was almost like a double discounting. And so we've seen the first installment of the correction there to the upside for our funds with this notion, and it's again the forecast that interest rates will come down. And we would presume that if they do come down, for the reasons we think they're going to come down, the most important one being deflation, then our funds will be in good shape because we are very, our companies thrive on deflation. Technologically enabled innovation is deflationary.
So, Kathy, a very good morning to you. It's Manus, first time we've met on. So we're going to move to a deflationary environment. We'll come back to the big macro call in a moment. Just let's square it away before I talk to you about the flows in the funds, which is how much interest rate cuts do you presume are you forecasting? Leave the forecast of everybody else aside. What do you presume will happen next year?
Well, we put up a chart in one of our in the Nose, which is a YouTube video that I do every month, Employment Friday, and in that chart you will find a ratio. It's the metals to gold ratio. So metals price to gold price. And there has been an extremely tight correlation between that ratio and long-term interest rates. In October, we published it, or early November, and what you will see is that there was a very wide gap that had developed. The metals to gold ratio was near its low for the past 12, 15 years, and interest rates were at their highs, 5%. The correlation, if you just eyeballed that chart, the correlation suggested that rates should go to 2%. Now, maybe they won't go all the way to 2%, but we think that long-term interest rates are way above where they're going to end up because of deflation.
Okay, well, we'll come back to that and see whether we get to the 2% level. I've got to ask you about the flows into the funds, which is obviously, as Carol just said to you, you've got a bit of a victory lap going on at the moment, but this is the first year of outflows. Have those outflows stopped? You've had a great performance in the back part of this year. Have the outflows stopped? And has that bleed stopped?
Yes, well, we were very gratified at our asset retention in 21 and 22. In fact, we had net inflows, if you combine both years, of more than $18 billion. And this year, one might expect that those who average down into the very steep declines that we were seeing in 22 especially, might take some profit. So we have had, I know for our flagship strategy, it's roughly $500 million in outflows, maybe for all of our strategies, 1.8 million. So maybe 10% of the inflows that we enjoyed during 21 and 22. So again, we're very gratified and grateful to our clients for the support that we continue to receive.
So has the outflow stopped?
We have had days of, on balance, very recently, yes. And I think part of this is many people do tax management toward the end of the year. And so some of the outflows might have been associated with clients who got in at a high cost base and we're just harvesting some tax losses. But I think we're through that.
Do you find it a little surprising, though, Kathy, considering the run-up? Or I'm curious about the conversations you do have with investors, considering the year that you're having and then to see those flows. It's got to be a little disheartening. Yeah.
Oh, no, not at all. Actually, we put out a piece for Resolute, our distributor, who, and we basically showed to them, if you rebalance our strategy, when there have been big moves one way or the other, if you rebalance regularly or based on a rule like when the fund's up 15% relative to everything else, take some profits. And what it showed, that study showed that if you are disciplined that way, that over any rolling 5-year period, it is highly likely, almost 100%. I'm not quite sure if it's quite that high, but that you will beat the market, meaning as measured by the NASDAQ or the S&P, over a rolling 5-year period. And so a lot of our funds are with advisors who are very sophisticated and responded somewhat, perhaps in this tax management part of the year, to that message.
All right, sit tight. We're going to come back, Kathy. It's amazing that we actually haven't brought up Elon or Tesla yet, so we want to get into that as well. Kathy Wood of ARK Invest, she's going to stay with us. Of course, founder, CEO, CIO of ARK Invest. Lots more in terms of the conversation. Curious to a little bit more about AI, NVIDIA. There's just so much. If you're just joining us, though, right now, folks, the S&P 500, call it little change right now, 48.34. We're just up about 1 point, so call it flat in terms of a percentage basis. But more with Kathy Wood. She's coming up. Quick check on the 10-year, 381, a little bit higher, as we've talked about some of the auctions and good demand in terms of that. We're coming back in just a moment.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
All right, everybody, let's get back to Kathy Wood, founder, CEO, and CIO of ARK Invest. She's joining Manny and Manis, of course, and Katie and myself here on Bloomberg Surveillance. Kathy, I feel like we have to talk about Tesla and Elon Musk. And I know you just had a conversation on Twitter X. This has been, I think, from day one, right, in terms of you starting out, that you've had this investment in Tesla. And I remember when we first talked and you were getting started, you talked about him being the next Thomas Edison and how his vehicles would turn the U.S. economy upside down. Having said that, there's an evolution and the EV world has changed. How are you thinking? It's still a top holding. How are you thinking about the Tesla story right now?
Well, first of all, Carol, thank you very much for letting me interview that time. That was nearly 10 years ago. ARK is about to celebrate its 10th year anniversary, and you gave us that opportunity, so thank you. The world is evolving, actually, I think, even more closely to what we expected. Because we expected a lot of traditional auto manufacturers to see the writing on the wall and rush as quickly as they could into scaling big time into electric vehicles. And what has happened recently? Both GM and Ford have said, we're stepping back. We're not going to do this until it's profitable. The problem with that is, in order to be profitable, they need to scale. That's how this works. These are learning curves that they are riding down, and those are expressed in cost declines. So The fact that they're pulling back means there's more share for Tesla and others who choose to go for it.
And Kathy, I want to keep the conversation going on Elon Musk, but I want to bring it to the ARK Venture Fund. Of course, it's not an ETF. You invest in private companies, et cetera, in there. And you take a look at the portfolio, you have SpaceX in there, and you also have X, formerly known as Twitter. And in July, you had told the Wall Street Journal that you had written down your Twitter stake by 47%. Fill us in on the past couple of months. Have you written it down further, or how has that changed?
No, I think it's still there. We have to be very careful. This is an interval fund. It is a 40 Act fund, and we have to market every day. The good news is our clients can get in and have access to these amazing companies for just $500, and they get quarterly liquidity. So that's the good news. The markdowns are simply, if we see in the secondary market employee stock trading at a steep discount, we have to take that into account. If we see others in the more traditional asset management world, like Fidelity and others, marking their holdings down, we need to take that into consideration during our daily mark to market. So it's an abundance of caution. We have a 5-year investment time horizon. Do we think that's where X belongs in terms of valuations? Absolutely not. Absolutely not. A roughly $20-ish billion valuation for what we believe truly will become the everything app. Think WeChat Pay. Elon started his entrepreneurial career in the payments industry, and he's been thinking about this for a long time. He now has money transmitter licenses in more than half of all of the states, which we learned on Twitter Spaces, or on X Spaces, I should say, the other day when we had our interview with him. So that's exciting. He's going for it.
He's going for it. We'll see if that one lands. But let's talk a little bit more about the private markets, because obviously the private credit market has gotten a lot of attention right now. You're looking at the private markets through this interval fund that you have. When you think about the opportunities there on that 5-year horizon that you have, do you see more so in the public markets or in the private markets right now?
Now that we've had this very nice run this year, we think the answer to that question is in the private markets. They're close. They're close. What's fascinating to us is that the public markets have been leading the private markets for the past 3 years. As our funds were falling in 21, private valuations were going to all-time highs along with the NASDAQ. They were taking their cues, I suppose, from the NASDAQ. But real innovation, if you looked at our portfolios, was starting to revalue to the downside, and even more so in 2022. We are still seeing major down rounds taking place in the private markets. And I'm always surprised at this sort of thing, because you would think that the private markets lead the public markets. That has not been the case in the last few years.
Hey, Kathy, I've got to be honest with you. I think whenever we think about Elon Musk, brilliant, but also erratic. And I'm curious how you think about Elon, the individuals, versus Elon, the companies he's creating, the things he's doing. Because I think if there is time, any other CEO of a major publicly held company would, I think it's safe to say, not be able to get away with a lot of what he has done. So help us, educate us, how you make sense of it, of someone you have followed, talked with for many years.
Well, first of all, very often we just look at what he does, not exactly what he's saying, which can often be a distraction, or it can be an advertisement for his cars or for X or for SpaceX and so forth. So, but we have a scoring system as we are evaluating companies and their founders and their management teams. There are 6 metrics, and one of them is moat and barriers to entry. And I think Elon is a maestro of raising barriers to entry with innovation, that is so much faster than anyone else. Why? Because he's so first principles, physics driven in his analysis of how to approach a new idea, a big idea.
So tell me this then, Kathy. I mean, if you look at the cohort of the CEOs that you back, Brian Armstrong, does he hit that bar? Is he above Elon, or is he at the money? You've got Elon, you've got Brian, you've got Tony Wood at Roku. Does anybody come close to Elon, or is Brian Armstrong maybe even at the money with Elon or above?
Well, we don't actually look at the world that way, one relative to the other in terms of management teams. We do look from our scoring system at the scores, which include moat, management, people and culture, execution, valuation, that might surprise people, and product and service leadership, and thesis risk. Those are the 6 scores. And all 3 of them score very highly. Which one scores the highest? They're actually very close to one another, to be honest.
They're very close to one another. So, I mean, obviously, Coinbase is one of your key holdings. We've talked a little bit about that. The other feature that we want to talk about is AI. I'm curious to know, in OpenAI, the valuations have ranged between 80 billion to 100 billion. Will you take a position in OpenAI? Is that going to be part of your holdings as you explore the next development of AI in your holdings?
Well, in our private portfolios, we are already exposed to Anthropic, which has been a major beneficiary of the drama around OpenAI that we all witnessed a few months ago. But if you look at GPT-4, which is the latest large language model that OpenAI has published, it is way above others in terms of performance. So there you have it, the pros and the cons. Mm-hmm. So we can't tell you what we're going to do in that portfolio, but we are so impressed at how OpenAI has led the industry. We're also impressed, however, at the open source models, and we'd like to encourage more of that movement. We know that Meta Platforms has with Llama 2, and it's working on others, is moving very quickly and making great strides. So for much lower cost, open source is free, companies can get close, not right at GPT-4, but close. So we want to see the open source movement. In the venture fund, we also own...
Kathy, we've got to...
sorry.
No. We never have enough time with you. Can I ask you a really quick question, 5 seconds?
Sure.
Any new ETFs coming our way from you guys next year?
Well...
real quickly.
As you may know, we bought a company in London.
Yeah.
They have some very interesting funds.
All right, gonna leave it there. Like we said, we always leave our audience wanting more from you, but we so appreciate all the time you gave us. Happy New Year, of course, Kathy Wood, founder, CEO, CIO of ARK Invest. If you missed any of it, check it out at Bloomberg.com. Coming up, Anna Rathburn of CBiz. This is Bloomberg, everybody.
Politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Ahead to 2024. We are expecting the Fed to cut first. 2024 will be very much the same as we move into a period of time where there's an expectation of a Fed pivot.
I think the Fed is going to be forced to cut to just get out of very restrictive territory.
We're not getting 6 rate cuts. If we're going to get 6 rate cuts, that's probably because the economy stinks.
At this stage of the game, I think, it's a question of when the Fed cuts and how much they cut.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
And a very good morning. Gotta love that. 6 rate cuts means, folks, things are coming undone. All right, having said that, though, on this Thursday, the NASDAQ on track for its best year since 1999. We've got the Dow sitting at a record. Could the S&P 500 be next? And global bonds set for a record 2-month run. From New York City, a very good morning for our audiences worldwide. This is Bloomberg Surveillance, live on radio and TV, alongside Manus Cranny and Katie Greifeld. I'm Carol Masser. Yeah, that's our setup on this Thursday morning.
An everything rally. Here we are.
An everything rally.
Yeah, but that NASDAQ
Fly
55%.
in, all in.
Yeah. Kathy Wood seemed fairly, robust. Her inflows, she's had a tough year. I mean, I like what you asked her, where you said to her, is this a victory lap? And she was very modest.
Well, it's, you guys know this. We bring her up in the newsroom, and there are people who are fans and respectful of her strategy. And if you look at traditional Wall Street, there's a lot of folks who have all of a sudden created innovative funds, disruptive funds. So really noting her strategy. At the same time, there are a fair amount of critics.
Yeah, a lot of copycats to pair with those critics. And I'm glad you asked about the outflows, because it's such an interesting case study. Usually you would expect flows to follow performance, even though she absolutely is crushing it this year. You can't argue with those numbers. You've seen net outflows in almost every single one of her ETFs. It's curious to see how that dynamic shapes up next year, especially if we get this this friendlier Fed that everyone is expecting.
Right, if it's a more difficult year, like what happens with investors in her funds.
To be fair, it was the comeback year for her, up 73%. And then if you look at it over, this is the ARK Innovation Fund, to be fair. What was it? Over 3 years, down 25%, and over 5 years, just eking out a gain of 9%. So, it is a question. It is, but she's almost like an evangelist name. So the question is, has she still got the Midas touch? She saw a lot of stocks very early. You've got to give her that. You've been interviewing her for how long? 10 years?
10 years. Tesla, Moderna, these are stocks that weren't necessarily on everybody's radar in terms of some of the work they were doing. Elon, right, for such a long time and what he was doing was not getting any kind of respect, and she kind of stuck to her knitting, if you will, and stuck to her fundamental thoughts on this company.
She did say OpenAI. They were very, very impressed with that. She didn't actually commit to say whether she was able to take any, get a hold of any, but I think it's probably too early for that.
I wish we had more time, because we've been talking about in the newsroom. NVIDIA was a miss.
I know, yeah. And you think about her public portfolio. I know it's AI as a theme is represented in her venture fund, but you take a look at her public portfolio. She does have some meta exposure, et cetera, but AI doesn't seem to be a huge theme there.
And she has owned NVIDIA, and her concerns were about valuation, but it's had quite the run, right? The best performer in the S&P 500. This year.
And I mean, we saw the Mag 7 outperform the S&P 500 in the front half of the year by over 100%, and then it sort of tailed off ever so slightly in the second half of the year. It's just a less magnificent performance, but it's still there.
All right, speaking of performance, let's see what's going on with the market setup on this Thursday. Let's get to it. Quiet. We've been talking about it all morning. S&P 500 futures. There it is. Unch. Take a picture now. Get it. 48.33 is your read on the S&P 500 futures. 111, right? Parity. I wish there was parity with the euro when I was overseas.
You go shopping.
Yeah, it would have been a little bit nicer. Wasn't too bad, but 10-year note, 381. So we've seen a little bit of support upside to the yield on that 10-year. New York crude down for a second day, down another 1.2%, 73.22, as we continue to always keep on our radar what is going on in the Middle East, concerns about the conflict as the U.S. Secretary of State here, Antony Blinken, gets ready to head overseas. All right, having said that, we've got a good setup for our next guest. Anna Rathburn is Chief Investment Officer of CBIZ Investment Advisory Services. Welcome, welcome. Almost Happy New Year. How are you thinking about the new year when it comes to an investment basis?
Well, so the markets have been kind of riding up on hot air, and that definitely makes us nervous. We're diversified investors. We have diversified portfolios, so this ride-up has been very nice, but the upside didn't come from when valuations were super low. So it wasn't a huge buying opportunity. And certainly the fundamentals don't look all that strong going into 2024. So while we are just as excited about innovation and what that can do to the economy, like Kathy would, it doesn't mean that the other areas of the economy won't have weaknesses. And that makes us a little bit nervous.
Anna, good morning. So you see a red flag when you see such a rapid decline in bond yields. Would you be then exercising the intent to be longer of duration as a hedge? Do you think bonds will be a hedge to a slowdown in the U.S. economy next year?
So the bonds and stocks, they've been moving with very high positive correlation. That's not always the case, right? So at some point, we are expecting that correlation to break down. When there's a lot of demand for treasuries, as we saw in the two auctions in the last few days, some of it, yes, is a rate cut expectation. But I always wonder to myself, why is there such a high demand? Especially when things are a little bit shaky, not only in the fundamentals of the economy, but also in the world in terms of geopolitics. It makes me a little bit worried that there is still some kind of a safety play built into it as we look forward. So in 2024, we do expect there to be a safety play into bonds. So holding on to bonds isn't so much that the yields are going to fall precipitously, as we've seen in the last 2 months. It's more about a safety play.
Well, getting deeper into the psychology of this bond bid, it seems like our word of the week on this program is FOMO. In explaining the bid for duration, how much of it do you think could be FOMO, that people missed out on 10-year yields at 5% and they want to get to them before they get back down to 3%?
I think there's certainly some of that FOMO. I would expect to see FOMO more on the equity side than in the bond side, but certainly those yields are very attractive. And the two auctions that I was talking about is 2-year and 5-year. So we're not talking about long duration. We're talking about shorter duration. So while there is a desire to capture that high yield, I think there's also desire to play it safe, because those shorter term treasuries are more liquid than the longer ones.
And lucky us, of course, we have another auction coming up today at 1 p.m. 7-year note, so in the intermediate space there. But let's get to equities, because you write in your notes that right now the equity market looks a little expensive. You take a look at valuations, but then you consider the psychology of this market, the FOMO bid. Does that overwhelm maybe some concerns about valuations at this juncture?
Not really. So I do think that I am waiting for some kind of a calendar effect come January. But also, a lot of the FOMO in the equity markets has been from the retail investors. And there is a little bit of a history sort of tells us that there's a little bit of a pattern of when the retail investors get excited about FOMO. Sometimes the valuations are in the overstretched area. We do believe it's overstretched. The fundamentals don't look that great. And look, even if the Fed cuts 6 times as the market is expecting, I don't believe that will happen, but let's just say it does, 25 basis points each, that's still just about 150, 160 basis points down. That's, upper threes in terms of Fed funds rate. We haven't seen Fed funds rate that high since 2008. So let's not get too excited about these rate cuts. Optimistic scenario, the Fed funds are too high.
Do you feel like next year we could have a year where there's a first half and a second half in terms of the trade? How should investors be looking about it, especially as we kind of try to strategize and figure out what global central banks will ultimately do?
Yeah, so first of all, global central banks, they're all combating different inflationary profiles. So this idea that everything is going to go the same direction, as we have seen in the last several decades, I don't think that's necessarily true. So the first half of the year, I think the risk is to the downside in overplaying these Fed rate cut expectations. So as soon as we have some kind of data point on inflation or the job market that actually works against these expectations, we have to be careful on that. But the second half, I do think that there is high expectation or probability of the Fed actually cutting. And if that's the case, that would definitely be more profitable for the markets.
Anna, let's get your call as we close out the week. Everybody's talking about diversification, move further away from Mag 7. Mag 7 outperformed the S&P 500 by 100% in the first 6 months. That tailed off in the latter part. We're showing that to our audience and to our radio audience. It's the outperformance of Mag 7. I mean, this was based on earnings growth, robust cash flow, strong balance sheets, and cost cuts. Can that endure in 2024?
There's been some comparison of what we're experiencing now to the 90s. And I don't like that comparison because what we ended up was with a tech bubble, right? So, but I don't think that that's the case here. Okay. As you say, the fundamentals have been solid. What the risk there really is on the entire S&P 500 and looking at the gains and thinking that we're okay when it's really 7 stocks. But as I said, there might be a short-term volatility. Certainly the valuations are stretched, but there's a lot to be excited about innovation and technology and how it's going to actually change the way we work and make us more productive. So for the long term, in a diversified portfolio, I think there's a place for them.
Can I ask you 30 seconds just to wrap here? What is it that you guys internally spend the most time talking about? And just quickly.
Yeah, so of course valuations, of course earnings and fundamentals, the economy, consumers is a big, big topic because ultimately in the United States, the economy is really driven by the consumers. But lately we've been talking a lot about geopolitics. The Red Sea situation is inflationary. So really, we don't really know what's coming in 2024. I'm a little bit surprised that after having gone through a supply chain debacle in the last few years, we don't look at this as a potential risk, right, to the supply chain. It certainly is. So geopolitics has become a big topic for us.
All right, going to leave it on that note. Thank you so much. Curious about what the Fed might be talking about when it comes to geopolitics. Anna Rathburn of CBIZ, thank you so much. Happy New Year to you and yours. February 1st is our first Fed meeting. So that's a long ways to go.
A lot to look forward to.
Can Powell double pivot backwards? He changed a lot. What was in the space of 2 weeks? He went, one thing they were cutting out, right? Yeah.
Is a double pivot just a 360?
A double pivot gives you...
Stop that.
She's gone inside baseball on me now.
All right. No pivot, though, when it comes to S&P 500 futures. As we take a look at the numbers, we're pretty much unchanged. 48.33 is the last print. We are up 0.01%.
There's no drum roll in that, Carl, is there?
I think that's pretty inspired. That's something to get excited about.
You can yawn now,
I think
Katie.
if we put the percentage change year to date, it would be much more exciting.
We'd be jumping up and down.
Yeah, listen, it's been quite a run on the major equity averages, really, and so much of the momentum, right, coming from like late October. I mean, it really was a late 2023 rush.
I will say, I mean, Manus, you keep showing that chart about how the Magnificent Seven has really petered out, but even still, you think about the gains that the NASDAQ 100 has put together, and then you think about the sentiment over the summer, it was really pretty poor. And just the narrative whiplash that we've gotten this year, I'm tired, I'm yawning.
Well, you had a yawn at about 6:10. Apart from that, you galloped straight the way through. I think it's the look. Is this global bond market? Actually, it's a while since we mentioned global bond market rally. There is a U.S. bond market rally, obviously, that has lit the torch flame of a global bond market. You see, I did give it to you both in the end.
A carnival.
He's going to take it down.
No, I gave it to you.
Carnival,
the U.S. bond market lit the torch paper of a global bond market that delivered double-digit returns globally.
We do have the Carnival CEO tomorrow, which will be a lot of fun.
I'm really looking forward to that.
We talk about the Magnificent Seven, but I'm looking at small caps since late October of 26%. So
parabolic.
Yeah, parabolic. But it's been a broadening out, right? A lot of market strategists have been talking about that broadening out of the rally, healthy, good. But if the U.S. economy starts to come undone in 2024, watch those small caps pull back.
Yeah.
All right, coming up at 8:30 a.m., our market conversations continuing and the economy. Lara Rame of FS Investments reacting to U.S. jobless claims data. Yeah, it's a quiet week, folks, but in just a few minutes, just about 17 minutes from now, we've got a read on the labor market.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
We have the supply side story coming from the U.S., and the market wants to see inventory draws start to come. And prior to this escalation and possible rerouting of things through Suez and avoiding the Red Sea, we saw big builds coming in January, right? Now it's looking more flattish, and we'll start to see draws in February and March, and that's where we can start to see that build up in crude prices.
All right, everybody, welcome back to Bloomberg Surveillance. That, of course, was Nadia Martin-Wiggin, director at Svyland Capital. And it's interesting, they're talking about the energy markets. Oil, we do see it pulling back for a second day. This, as we continue to see stockpiles here in the United States building up. We do have thin volumes in terms of the trade, but let's bring up some of the market numbers, if we may. Brent crude just down about 1.5%, $1.21 to the downside, 78.44 a barrel. We've talked about the equity side, unchanged, quiet. Is anybody around? Anybody? Hello? hello?
They've all
Anyone?
left for New
Yeah, you
Year's.
take a look at volume, it would suggest that people are celebrating early.
They are. Never too early for a glass summer. But it's interesting you see the oil market pull back by 1.5% because we've got further stockpiles. This is stockpiles versus geopolitics. Stockpiles in the U.S., again, romping home at Cushing, Oklahoma for 9 weeks in a row. So that supply and that inventory build is what's crushing the spreads.
Thin volume, though, so we have to be careful, right, in terms of a trade. Like, you get some overreaction.
Overreaction for sure. So important to take these moves with a grain of salt. But still, Manus talks about the supply. And then you think about the situation in the Red Sea. There's a really interesting story on the terminal that half of Red Sea container ship fleets are avoiding the Suez Canal, that route, after the attack.
That's a mighty number.
Oh, yeah.
And the cost of transport, the additional cost that's going to be leveled onto the world. And conflict is inflation.
Yeah, exactly. Nobody wants to take the risk, too. All right, let's get to it then. Ellen Wald, she follows the energy markets, has for a long time. She's senior fellow at the Atlantic Council and author of Saudi Inc. Ellen, great to have you back here on Bloomberg. So how are you kind of adding up some of the tensions that are happening in the Middle East? We're talking about stockpiles here in the United States. What does it mean for the energy markets?
One of the important things, at least, that I'm taking in is to kind of pull back and look at the larger Middle East geopolitical picture here. And if you kind of step back, you'll notice that there have been apparently 103 separate attacks on U.S. troops across the Middle East, even in places where at least I wasn't aware we even had any troops. And that's a very large number. And that's been since I think October 17th. And to me, that says that things are kind of bubbling under the surface, potentially escalating. And then on top of that, you've got Iranian drone attacks on chemical tankers in the Indian Ocean. And you've got this Red Sea situation, which is just getting more and more tense by the day. Like you said, you've got half of all container shipping is avoiding the Red Sea. And then when you look at the oil situation and the oil product situation on top of that, I think there is a real risk for Europe here. Not that they won't get the products and the crude oil they need, but since they're no longer buying from Russia, they're basically either importing from the Middle East. So now that a lot of that's got to go around Africa, or they're importing products, say, that are made maybe in India from Russian oil. That's also got to go either through the Suez Canal or around Africa now. So we're talking about longer transport times, higher costs, higher insurance costs, and just a general higher risk. And to me, like you said, that sends the idea of inflated prices, though, of course, we've got to balance that with these higher stockpiles.
Well, let's just focus in on the Red Sea. We have this coalition, and a hefty coalition of defense, trying to help shippers return there. You flag a concern about to what extent will this coalition actually be prepared to protect the maritime fleets going in there? Because the last thing the coalition of the West wants is a deep escalation. So you doubt the teeth of this coalition of protection.
Exactly. I think that the fact that it's been assembled does not necessarily mean that it's going to do anything. I think there's been a lot of hype about kind of the coming together of this coalition. But to me, that says too little, too late. Where was this coalition last month when container ships and tankers were being attacked? And it doesn't seem, it's one thing for the Houthis to say, okay, we're going to attack Israeli-linked ships. Now they're just basically attacking anyone. A tanker that was going from Pakistan to Saudi Arabia was recently attacked and had no links to Israel or anyone else. So to me, this says that they're going to continue to be emboldened. They're going to continue to step up these attacks and at defensive positions. We've got U.S. destroyers in the Red Sea trying to basically intercept these attacks as they're happening. That may not be enough. In fact, it's looking like it's not enough for most of the shipping industry.
Ellen, you lay a very febrile image in my mind in terms of what's actually going on. And I think we're so physically far away from it, sometimes we don't really understand the level of risk. Why such a phlegmatic response from the energy markets in that case? Is it just thin volumes, as Carol said, or is it, nah, this will pass, we've seen these flashes in the pan before, we don't need to worry that much? Why such phlegmatic response in the energy market?
That's a really great question, and I think it's a combination of high production levels from the United States. There's a sense that this, 13 plus million barrel a day production is just going to offset risk, which I think is a bit of an oversight. Then you've got the fact that nothing has happened before. And then you've got the fact that I think it's in the interest of the Biden administration to avoid a larger conflagration at all costs. But on the other hand, they may not be able to do this. And the risk of a conflict, while still low, is not zero at this point. And I do believe that that number is getting higher the longer that these attacks on international shipping are allowed to go on.
Well, Ellen, given that that is a non-zero risk in your view, I mean, you think about the war premium, to borrow a phrase from Manis, that's priced into oil right now. Should there be more of a premium priced in?
I do think that there should be, particularly as we go on in the year. We're at a period now of generally seasonally low demand, but as we head into, say, April, May, when things pick up, I do think that that premium, if this conflict has not been resolved by then, that premium should definitely be much higher, particularly if OPEC Plus is going to continue to hold barrels off the market.
How much higher, Ellen? Give us a quote.
That's a good question. I don't like to predict oil prices, but I wouldn't be surprised if it's more than several dollars a barrel. I do think that this risk is being underestimated now, and I think that the fact that U.S. supply and the fact that we know OPEC is holding so much oil off the market is kind of negating that geopolitical risk at the moment.
Above 80?
She's pushing.
I'm not going to say no.
All right.
Wow, that would be a very different trade than what
it changes the dynamics
now.
for the White House as well in terms of refilling the SPR, I can tell you that, and the price cap.
Ellen Wald, thank you so much of the Atlantic Council. Really, really appreciate your insight on what's going on with the energy market. Right now, WTI crude, we're looking, it's down about 1.4%, 73, just a little bit above 73 a barrel. So very different trade.
A very different trade, but even still, it feels like the dominant story in global energy markets is just the supply picture. And I mean, Ellen brought it up. You think about the U.S. Shale industry, just record production levels there, sort of maybe bedeviling the efforts of OPEC here.
Well, what are the numbers? The U.S. produces 13 million barrels of oil per day, but it's still actually a net importer. So you need to just sort of shift your vision on this, because even though it's producing 13 million barrels, it still needs more than it produces, and its exports are at a record. But whilst all of that's going on, the Swan is moving away, which is refilling that SPR. Amish Hochstein will be having a lovely week. He'll be just scooping up barrels of oil and throwing them into the SPR.
I find it fascinating that we're talking about this. Yeah, but
it's a holly jolly. Yeah, there you go.
But so political, right? Yeah. Like, I mean, it's in terms of, we were thinking, so much more in terms of renewables, but it's like, here we are once again talking about ramping up some of the drilling potentially that we're doing here domestically.
Well, I think it's also a question of timelines, right? Of course, the Biden administration, the U.S. government has these lofty goals when it comes to clean energy, but you have to deal with the here and now. You have to deal with how much oil this country needs.
But those goals have perhaps, as we heard from one guest, delayed an additional ramp up of oil production here. But of course, to coin Mr. President Trump in his lines in the interview recently, drill, drill, drill. That's what he intends to do.
Kind of fascinating. We didn't even get into Iran, which I also think about, when it comes to the energy markets, what they'd like to be doing, what they can't be doing, and how we talked about yesterday that they would look to kind of destabilize the United States continuation. Hey, coming up next, Lara Rame of FS Investments reacting to the U.S. jobless claims. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
And a very good morning, everybody. This is Bloomberg Surveillance live on Bloomberg Television and Radio, alongside Manus Cranny and Katie Greifeld. I'm Carol Massar. Quick check on the markets for you on this Thursday. Not much going on. Just up 1 point on the S&P 500, 4834. Yesterday, it was the Dow that hit a record. The stocks hit a record. The S&P did not. Does it happen today? I don't know. The momentum is pretty mellow. New York crude, we were just talking about the energy markets down 1.3%. We did get some reads on U.S. stockpiles, 10-year 3.80. All right, to under surveillance we go. Some of the headline stories we are watching for you. Xiaomi unveiling its first electric vehicle, declaring ambitions to become a top global car maker in 15 to 20 years and compete against Tesla and Porsche. The SU7, which stands for Speed Ultra, has a range of up to 800 kilometers on a single charge and a top speed of 265 kilometers. Yeah. Range
that is a big range.
You don't have to be worried.
I was going to say range anxiety is real, but you can go pretty far, 500 miles. So,
yeah, you can go really far.
I think what's going to be interesting is the price point at which this car comes in, and just looking at it, the SU7. So they're trying to set themselves up to rival a Porsche Taycan Turbo and Tesla's Model S. So they're coming in at 200 to 300,000 yuan. That is way under where the Model S.
What is that US?
Well, you see, I'm global, so I haven't got that in dollars for you. I'll talk about the currency at which it goes, 698,000 yuan. I'll get you the dollar price in 2 ticks of a lamb's tail.
TBD. All right, let's get to the other story. Norway's largest pension fund pulling $15 million from Persian Gulf companies over concerns of human rights violations and climate risks. Saudi Aramco was blacklisted in addition to a dozen companies in the real estate and communications sectors. KLP manages $70 billion for pensions in the Norwegian public sector and calls itself a responsible investor. So we watch what they do, right? Because, I don't know, some people might say woke capitalism, right? But it's interesting to see what they are doing. And
well, they raise a couple of critical issues around Saudi Aramco. They're saying that the energy transition plan that they have has failed to meet expectations, and they talk about other countries and companies in the Middle East, in the Gulf. They've got concerns around human rights. It's hardly what you call a massive amount of money. So I think it's more the principle. It's a $70 billion fund. What we're talking about here is a reduction of $15 million.
Yeah, I was just thinking that maybe that's a drop in the bucket, especially in.
I think it's more about principle over dollars.
Exactly.
Making a statement, right?
The symbolism here.
All right, one more story for you, and that has to do with some breaking economic news. Just out moments ago, U.S. initial jobless claims up 12,000 to 218,000 in the latest week, 8,000 higher than estimated. So does that say that there's some concerns about the labor market, maybe not as tight as it was, but a little bit of an uptick? It's hard to say. I don't know. You know, I feel like when we get around the holidays, maybe some
there's a lot
things
of temporary
happen.
hiring. There's a lot of adjustments in there. We've just come off the back of the strikes. Where are we as we go into 2024? But next week's going to be a big old week for jobs.
Not seeing any reaction, no surprise, in the markets. All right, let's see what Lara Rame has to say. She's chief U.S. economist at FS Investments, joining us on this Thursday. Lara, great to have you here with the team. So Let's go to jobless claims first of all. Is that significant in terms of that uptick?
So this 1 month of readings is not significant, but this indicator to me is one of my most watched indicators. The fact that it's been low, really, Carol, uninterruptedly for months and months now, to me says that while there are concerns about the labor market renormalizing, or people are starting to talk about cracks in the labor market, when I look at this indicator, I see companies still really eager to hold on to workers. They may be taking more time to rehire if somebody's lost. They may be, a little more rational about job openings. But when it comes to layoffs, companies are very closely guarding their workers. And I think that has big implications. It has had throughout this last year, and going into next year means that it's one of the reasons why the economy has been a lot stronger than a lot of us expected.
So the labor hoarding continues. I want to ask you about JOMO replacing FOMO. What exactly are we talking about?
My idea for the coming year is that the business cycle lives and dies around the consumer. And the consumer has just been surprising with spending strength throughout this expansion. That is still a very young expansion. The FOMO, we have to, now's the time to spend. We've put it off. We have to go take the trip, buy the car, whatever it is, we're going to find a way to do it. That is going to be replaced by a more moderate sort of JOMO, joy of missing out. It's just a way of saying that people may choose to have more staycations. They may start to be a little more budget conscious. That's not to say that household budgets are in trouble, but we know that credit card debt is high now, and interest rates on credit cards are, unlike home mortgages, they're not fixed, right? They are moving up fast. So it's this idea that over the next year, we're still going to have a healthy consumer. We have a healthy jobs market. We are not going to get the consumer in contraction, but you're going to have a consumer that's maybe a little more moderate and maybe decides that they can wait a little bit or defer some joy instead of taking it all right now.
I think we have a new T-shirt and hat and coat
JOMO.
series to make it.
JOMO, weaponized FOMO. This was our guest the other day, by the way, Lara. Our guest the other day said that we all had weaponized, we have weaponized FOMO, but now you've christened a new one, JOMO.
I love it.
It's almost like it can be a boy band or a band of many. I want to know.
Catch on by mid-year. You won't believe it.
You are in the camp of uncomfortably high inflation in 2024. Now, does that just mean we get stuck where we are? Because the disinflation has been really quite aggressive, one could say. But you say we're going to get persistently high inflation. What is that going to do? Is that going to mar the sort of the clarion call for multi-rate cuts of 150 basis points in the U.S.?
I think we do get stuck where we are, and I would argue that where we are is uncomfortably high. And I think it does three big things. The first one is that it keeps this wet blanket on consumer sentiment. We've seen this trend of households spending a lot, but also in surveys being very downbeat about the economy. I think that gap has to close, and I think it closes more towards spending decelerating, and part of that is the inflation picture, and partly the housing affordability picture too. The second thing it does is give the Fed less room to maneuver. I don't think that 6 rate hikes in a non-recessionary economy is a likely outcome. I could see them strategically trying to cut rates, but the reality is that with inflation where it is today, it's very hard for me to see them just making the deep sort of programmatic cuts that they do when we're seeing a recession. And the third thing it does is really challenge fixed income investors. I think everybody looks at, the 2-year at 4.25. They think that this is it is a multi-decade highs, right? It seems like a very good investment. When you think about inflation at 4% versus 2%, your real return is much smaller than you'd think.
Should we be talking about the possibility of another rate hike here? You mentioned that against this sticky inflation backdrop, 6 rate cuts maybe looks unrealistic. Is there a possibility that the Fed has to hike rates again in 2024?
I was one of the last holdouts saying that they would raise rates in the fourth quarter. Obviously, that didn't happen. I think from here, their messaging has really changed. they've talked about rate cuts being not an if, but a when. So the more likely scenario to me is if data really surprise to the upside, or we get, inflation data that really harms their, goals to cut rates, they would instead just hold rates steady here. I think it's important to harken back to the mid-90s. And this is something that I really cover a lot in my outlook for next year. Over 40 years, we do not have a good roadmap for non-recessionary rate cut scenarios.
Yeah.
And the mid-90s is one of the only episodes. They cut 3 times over 8 months, and then they waited almost a year and they raised again. So we have to be really, I think, careful. We just do not have a good roadmap. History is never a perfect guide, but in this case, we are really, I would say, in much more uncharted territory than markets believe today.
Flying blind to some extent there. So clearly a communication challenge for the Fed. Let's talk about the balance sheet, though, because that's one of the big questions. And Powell did get asked about this at this month's meeting. What happens to the balance sheet if they do try to do those sort of fine-tuning rate cuts and continue to roll off the balance sheet? On the, from the outside looking in, that appears that the Fed is working at cross purposes. How are you thinking about the balance sheet in relation to their primary tool of interest rates?
I think you bring up an important point, which is, again, speaks to the unique nature of easing monetary policy when we don't have a recession. It looks really different. And I think, first of all, the Fed would like to get out of the balance sheet manipulation game. I don't think it's a place where they've been comfortable. So I think to the best extent that they can, they'd like to de-emphasize that as a policy tool. And I think that's what they're trying to do right now. But I also look at the broader Treasury landscape, because over the coming year, we need to roll to almost $10 trillion, $9.7 trillion of Treasury debt that matures within the next 12 months. 3 years ago, that was only $5 trillion. So when I look at long-term interest rates, my expectation is that we will continue to hold, or this drift up pattern throughout the next year, sort of holding the same 3.50 to 5% range that we held this last year. And the reason for that is because, we think about the yield curve today, deeply inverted, but if we do get a soft landing, that will probably correct at some point through some rate cuts, but also some drift higher in long-term interest rates.
Lara,
it's a very different outlook.
20 seconds, really quickly. Are you ruling out a recession for the U.S. next year completely?
I'm not completely ruling out a recession, Carol. I think so many of us tripped on the landmine and now feel a little bit shy to come out and talk about a recession next year. I think the risks are still elevated. We need to look at traditional bank lending. We need to look at the lagged effects of higher interest rates. My forecast, though, is for slower growth, not a recession.
All right. On that note, we're going to say Happy New Year. Lara, always appreciate all the time you give Bloomberg. Lara Rame, of course, of FS Investments, breaking down the weekly jobless claims number, but really giving us a bigger, broader picture for the economy come 2024. All right, folks, we are just a little less than an hour away from the open on this Thursday. Looking at S&P 500 futures, it's been a really quiet morning as we continue to track what's going on globally. We've talked a lot about this global bond market rally on track for 2 months, best 2-month run we've seen in a record. Having said that, back to the U.S., S&P futures just up 0.03%. All right, having said that, are you going to bet on a record today for the S&P? Should we
I don't know. We'll see.
I think she's quietly got a bet on somewhere.
By the time the closing bells ring, we'll be long gone. So it'll be interesting to see how the actual cash trade goes. We are very, very close. Of course, you think about where we settled up. The record close is just below 4,800. We're just about there, but it's been painful.
I think it's an interesting point that we just had there. There's $9.7 trillion of U.S. government debt maturing in 2024. And so they're probably going to be asking themselves, what's the refinancing cost? This is the fiscal worry for the world in regards to the United States of America. Globally, but you've got the biggest, so you've got the biggest issue in the U.S. And I think that's a really sort of under-talked about point that we probably will spend more time talking about it in the new year, because we got 2 fiscal deadlines and potential government shutdowns in January in Washington.
Yeah, and that deadline for the next potential U.S. government shutdown is quickly approaching. But bringing it back to the Fed, I thought Lara made a really interesting point that we don't really have a roadmap here for what the Fed is trying to do. Just get out of restricted territory, but not actually ease policy. Well,
they haven't done it softly or gently since 1995.
It's a different environment, right? And I think we're still feeling the effects of coming out of the pandemic, right? And just kind of how do we get out of it smoothly? And it's not been an easy course.
No, society has irrevocably changed. Whether you are back at working in the office, but work from home, productivity, AI, all of those big themes will come to play in changing the inflation narrative.
Joy of missing out. I'm okay with it.
Defer your joy.
I'm okay. I can miss out a little bit.
Deferred joy.
Don't go anywhere. You're not going to want to miss our next guest, Aaron David Miller of the Carnegie Endowment for International Peace. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg.
Really the group that has been most engaged in both threatening Israel with its missiles and drones, as well as the Red Sea, have been the Houthis, clearly at Iranian direction. So I think that there is a very, very significant risk of escalation there. The American announcement of a task force to protect shipping is a good thing. It may not, however, necessarily ward off the Houthis.
All right, that, of course, is Stephen Cook, Counsel on Foreign Relations, Senior Fellow for Middle East and Africa Studies, and certainly the Middle East remaining on our radar on this Thursday. Quick check on the markets for you. Just got to read on weekly jobless claims, a little bit of an uptick, higher than what folks were estimating, but nonetheless, maybe not too worrisome. We just talked with Lara Rame talking about labor hoarding continuing here in the United States, companies holding on to their workers. Having said that, your market set up on this Thursday. We've got a 10-year at 380, just a slight uptick there. S&P 500 futures continuing to be unchanged, staying that 48.33 mark. And taking a look at New York crude, we talked about energy, very important as we watch what's going on overseas, and really looking at stockpiles around the world. Here in the U.S., some data this morning. New York crude just down about 1.4%, 73.04 a barrel. We do want to talk about geopolitics. Has really been front and center for us and the team here this week. Aaron David Miller is Senior Fellow at the Carnegie Endowment for International Peace. David, good to have you back here on surveillance. As you look at the outlook, are you more hopeful about what is going on in the Middle East, or are you more sober in terms of a potential outcome here?
Having worked on this problem for 25 years for Republican, Democratic secretaries of state, I think the answer is clear. Nobody ever lost money betting against the Arab-Israeli peace or Middle East stability. And I think wherever you look, there's a headache. The Israeli-Lebanese border, potential of escalation in regional war, not predicting it, but it's got to be watched carefully. The Houthis, 33 attacks, 100 drone and missile strikes since October 7. A problem right now without a good solution. The Israeli-Hamas standoff, mutually irreconcilable goals. Hamas wants to survive. The Israelis want to destroy it. People of Gaza, 2.3 million, half of whom are under the age of 15 to 18, are suffering. As a consequence, and the Israelis, of course, have been traumatized by the Hamas October 7 terror surge. So no, I look around as the 2023 comes to a close. I guess my prediction for 2024 is it's going to get worse before it gets much worse.
How does it get worse, Aaron? A very good morning to you. Blinken goes to the Middle East over the next 5 days. Multiple trips have now been made. But first of all, characterize for us how this gets worse. Is it directly in the Hamas-Israel conflict itself, more deaths, or is it an escalation via proxy?
I mean, I think the real concern, if you want to strip it down to its essence, the U.S. has three, I would describe them as vital interests in the Middle East. The must-haves as opposed to the discretionary interests, which are it would be nice to have. Number one, prevent a terrorist attack on the continental United States or its assets throughout the Middle East. Number two, maintain access to Arab hydrocarbons. And number three, prevent the emergence of a regional hegemon, in this case Iran, with the possibility of a nuclear weapon and then a deliverable. Those are the core interests that affect American security and prosperity. I think that, frankly, by and large, the U.S. has been relatively successful in managing all three of those. This conflict, though, particularly the prospects of regional escalation, the IAEA is now reporting that the Iranians are ramping up their production of fissile material. The problem here is we have a strategic problem out there, and we don't have a strategic solution. And of course, as you know, we're entering 2024 when it may well be that sound policy is going to conflict with political realities at home. So no, there are no solutions to the problem. Maybe we can continue to manage all of these things, but there are no strategic solutions to the Israeli-Palestinian conflict, what to do about Iran, or frankly, right now, trying to deter Iranian proxies, particularly the Houthis.
And with that in mind, our last guest suggested that the power, the force of the international community perhaps isn't as robust as we think in protecting the maritime rights in the Red Sea. Would you agree? Is that it's perhaps a powerful display of force, but it lacks teeth, and in actual fact, it could end up being a bigger issue for the West, this coalition, which isn't exactly a coalition with teeth and force?
No, I mean, Operation Prosperity Guardian announced by the Secretary of Defense a week or so ago. I mean, with the Houthis, we have three options, and I think we have to face up to them. Number one, change the route. The Cape of Good Hope will slow down considerably by 3 or 4 weeks. A global maritime transit, that's number one, and some shipping companies have already done that. Number two, go to a maritime coalition. And, in 2006 to 2010, the World Bank estimated that Somali piracy cost the world economy $18 billion. We were very successful then in mounting 120 ships by 20 countries. They almost staunched completely Somali piracy. This is more complicated because the Houthis are distant. They're inured to war, backed by Iran. They've yet to date been the only entity that has launched a short-range ballistic missile toward Israel. So the reality is deterrence may involve strikes, American strikes on Houthi targets in Yemen, but nobody wants that. The Saudis have just concluded an agreement with the Houthis, and you're going to be hard-pressed to get the Arab states to participate, with the exception of Bahrain, while the Israelis and the Palestinians are going at it in Gaza. So again, a tough problem. I don't see any easy solutions.
Well, let's turn to Gaza and Israel, because you wrote in Foreign Affairs just last week that Biden should continue to press Israel to quickly end its intense ground and air campaign in favor of more focused and targeted operations. So the Biden administration should continue to press, in your view. Is Netanyahu listening?
I think that the Israelis are going to make a virtue out of necessity probably at the end of January. Look, no Israeli prime minister, not even this one, wants to fight with the American president, and no American president wants to have a public dispute with an Israeli prime minister. It's awkward, it's potentially politically costly, and usually it's counterproductive. I think the Israelis have reached the conclusion that they cannot maintain a mobilization of 360,000 Israelis. It's having a negative impact on the economy and on Israeli morale. They will, I think, go to a less intense campaign, more intelligence-driven, operational activities against Hamas. But the reality is they are going to continue to operate at some level militarily in Gaza for months to come. The real question is, can you reconcile that with getting necessary humanitarian assistance in to relieve the suffering in Gaza, and think about what the day after and the day after the day after looks like? And that's the real problem. If the Israelis want a military solution to the problem of Hamas, they're going to have to deal with the underlying problems of Gaza in order to address it. And that's going to be extremely difficult to get help for the Biden administration to get a lot of help with that, unless luring the Arabs and the international community, they tether this to a broader solution of the Israeli-Palestinian problem. And that's going to be a very heavy lift for any administration.
Like a two-state solution, and whether or not we can get that done. David, we've only got about 30, 40 seconds. You said the U.S. has a strategic problem. They don't have a strategic solution. Do they have a strategic ally globally in this situation? And just quickly.
No, I think we're in it on our own. These are regional parties. The Middle East is littered with the reigns of great powers who thought they could impose their will on smaller ones. No, it's going to be extremely difficult for the United States unless they can mobilize regional partners, particularly get an Israeli and a Palestinian leader that are serious about doing something about what ails this region and the Israeli-Palestinian issue.
All right, David, listen, thank you so much. Aaron David Miller, thank you so much, of the Carnegie Endowment for International Peace. Aaron David joining us on this Thursday. You know, I keep thinking about what he said in terms of the amount of attacks and different attack points that are going on in the Middle East. Ellen Wall talked about 103 separate attacks across the region. So how do you really kind of mobilize allies and get some kind of solution? It gets more and more difficult each time one day goes by.
And I think this debate about Prosperity Guardian, which is the coalition of 20 nations, Bahrain, France, Italy, the United States of America is obviously the lead there. This is exactly what the proxies want. They want to provoke the Prosperity Guardian into a point of where there is a more major conflict, and that's everything that Iran would probably want, which is to chide the United States of America.
And you think about the container ships having to make hard decisions there. Do they trust that they'll be protected, or do they just
go around the Cape of Good Hope? Yep.
Yeah.
A massive humanitarian story, but a business story as well. Coming up next, Gershon Distenfield of AllianceBernstein. It's coming up.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway: its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Look ahead to 2024, we are expecting the Fed to cut first.
2024 will be very much the same as we move into a period of time where there's an expectation of a Fed pivot.
I think the Fed is going to be forced to cut to just get out of very restrictive territory.
We're not getting 6 rate cuts. If we're going to get 6 rate cuts, that's probably because the economy stinks.
At this stage of the game, I think, it's a question of when the Fed cuts and how much they cut.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City, for our audience worldwide, a very good morning. This is Bloomberg Surveillance, live on Bloomberg TV and radio. Alongside me, Carol Massa and Katie Greifeld, I'm Menace Cranny. So we're going to move from weaponized FOMO. This is the theme of the morning. We're going to move from weaponized FOMO to JOMO. I didn't even know that JOMO was a thing.
JOMO.
The things that I'm missing in my life, what are they?
The joy of missing out. Instead of going out, you stay in, you put on your streaming channel of choice, and
you don't spend money.
You just hoard that joy, and you defer.
And the money.
You defer it to a later date.
Our producer Amy Rosen knows about it. She remembered it during the pandemic, right? JOMO. Yeah, it's a new term for me, but it does. You do wonder at some point, do household balance sheets? They can't spend on stuff. They can't go do stuff. Maybe they have to rein it in a little bit.
Inflation is super high, and we've been talking about the consumer for years at this point, the miserable consumer sentiment figures that we're getting through in those surveys, and they're still spending, but now maybe we are reaching an inflection point where the outright level of prices is a lot higher than it used to be, and you have savings coming down at the same time.
Yeah, I mean, you're going to have sticky inflation. That was one of the narratives that we had. We've had the joy of Cathie Wood this morning. We've had a great conversation with her. We spent a half an hour together, and she's making some adjustments in her Bitcoin, well, vicariously, her Bitcoin exposure, exiting Grayscale and beefing up her positions elsewhere. But she was very gracious in terms of the year that she's had, up by 70%. So it's a turnaround for Cathie Wood, but overall, still the trajectory is tough.
As much as she's up this year, she's still down that much from her highs a few years ago.
And outflows.
Right, exactly. And outflows in the funds, which is kind of interesting in a year where you saw really dramatic gains where she outperformed many major market averages. But nonetheless, I feel like she continues to be such an integral part of kind of a market conversation and kind of what's going on.
But then has she become almost, I mean, you meet some CEOs, you meet some hedge fund managers, some fund managers, and they become almost bigger than the fund. They become bigger than the institution that they run. And that's always the risk. Has she still got the Midas touch, or has she become too big a name for the fund in itself?
Well, it's interesting to hear you say that, because really at the peak, it feels like in 2020, 2021, when her assets were at an all-time high, there was a concern that she wouldn't be able to invest in the stocks that she
wasn't it like 60 billion or so, or 60 something?
Yeah, because basically she had too much money and she was going into these smaller cap companies. So that is a prime example of getting too big for your actual fund. But of course, with the outflows that we've seen, not quite as much of a concern.
No, let's just check in on the markets. I don't think we're going to see anything dramatic or exciting, apart from the oil market, which is a little bit lower. That's because inventories are building at Cushing, Oklahoma for the 9th week in a row. 73.64 is where we are. Bonds at the moment just tick ever so slightly higher. We're going to dig into this story in just a moment. We have a global bond carnival. I love the headline that we've got this morning.
It's confusing.
I want to go to meat-eating bond traders, quiche-eating commodity traders, and salad-eating equity traders.
Are there clowns?
Is there a bond Ferris wheel?
Have you met your average bond trader?
I will say there's probably a roller coaster at the bond carnival. You take a look at the chart of the 10-year
well said,
over this
well done,
year.
very nice.
Not to be
Very
too
nicely
cute.
turned, but of course it can be litigious and precipitous. It can go up and it can go down. Let's actually take that thought. We're finished with the markets. Let's get to Gershon Distenfeld, co-head of fixed income at Alliance Bernstein. Are you at the carnival? I mean, you look at this performance. The Bloomberg Global Aggregate total return is double-digit. It's up 10%. And the U.S. is undoubtedly one of the most triumphant there, down 120 basis points on the 10-year from its late autumn peak. Do you think this carnival is just getting started, or does it run the risk of having already reached the dawn?
I think from a length perspective, we have a long ways to go. You've gotten a lot of the return already in the past couple of months. There's no question about it. We think there's more to come. We think rates are going to continue to decline as the Fed normalizes policy. You know, whether or not we go into a recession, a soft landing, those are all questions. But I think undoubtedly short-term rates are going to be lower a year or two from now. And most likely long-term rates will be as well. So there's more to go, but you got a lot in a very short period of time.
We saw a little uptick in the 2-year coming off of those weekly jobless claims numbers, holding at a level that we've seen as of late, coming in a little bit higher than forecast. Having said that, I do have a question for you, Gershon. I mean, when you talk about rates, where do you see that 2-year going if you think that there's more room to the downside?
Well, look, you know, the 2-year in the not so short, like in the intermediate term, is going to follow Fed policy. So we're going to have to see. I think that the market is really.
Well, wait. Can you commit though in terms of where you think it might go?
Can I commit? No. I mean, it depends. If the Fed cuts, 6 times next year, like markets are implying, maybe we'll get back to what that means. And maybe more, then yeah, it's going to go lower. If they're slower, then it won't in the short term. But the long term, the long term part of the curve can continue to rally if the market anticipates that yields are going to be coming down. You saw it on the way up, right? The long end of the market sold off long before the Fed started to move, and you're seeing the exact opposite now, and that's how markets work.
Well, let's get to the psychology of that bid for duration, whether this is basically people saying, okay, there's a growth hiccup coming, there is some growth concerns being priced into the long end, or whether this is duration FOMO, that I missed out when rates were super high at the long end, now I want to catch them before they go too low. Where do you fall on that argument, and how does that translate into the world of high yield credit?
Well, I think it depends on what regime that we're in, right? If you look at yields today, the long end relative to what they've been the past 15 years, they still look very attractive. If you look at it versus the past 50 years, not so much. When I started in the industry in 1998, the 10-year was about 5.5%, which was towards the low of what it had been over the previous 20 or 30 years. And everyone thought, wow, rates could only go up. And now you're seeing the exact opposite. So it really depends on what regime we're in. I think high yield credit is in kind of that sweet spot right now between the kind of extremes. So if things are okay, and if inflation's coming down, the economy's not going to roll over, the Fed's going to cut slowly, normalize rates, then equities are going to continue to do very, very well. But if we're going to go into a much more of what's called a recession or a hard landing, whatever you want to call it, equities are mispriced and long-term rates are going to rally a lot. But there's that in-between space, which might actually be the highest probability of like a soft landing type of scenario. And that's where credit and high yield in particular sits in that sweet spot. It's going to clip your coupon. You're not going to have a lot of defaults. And your returns may even be better than in the equity markets.
Maybe better than the equity markets. What about the private credit market? Because obviously this year has been boom time for the private debt markets. Do you see high yield being competitive with some of the returns that investors are finding there?
Yeah, I think it's going to be more competitive. That premium has come down from the private credit market. We're also probably going to see higher loss rates in the private credit market. That's not to predict any kind of disaster there, but they've been extraordinarily low over the past 10 years or so. So they're going to tick up a little bit. And high yields are more competitive today with the private market than they've been in quite some time. So definitely a high probability.
Gershon, it feels like that there's still, we're all kind of kicking around a lot of different scenarios in terms of how aggressive we might get in terms of rate cuts and how that impacts certainly the fixed income world at large. Having said that, so maybe a couple of different scenarios play out. Is there one part of the investment world in your universe that you think is probably a very smart bet for investors next year?
I don't have anything that stands out. You got to remember, fixed income investing is more about protecting the downside. We typically don't get, you don't get a 30, 40% return on a fixed income instrument unless you already had a problem and it sold off a lot. So, fixed income is about loaning an entity money, whether it's a government, a municipality, a corporation.
So where do you find the most protection then?
Well, obviously, the higher credit quality you have, the lower the loss rates are going to be. I don't think anything stands out in particular today. So we actually believe in some of our core portfolios follow this philosophy of more of a barbell approach, that in fixed income, it often, or most of the time, it actually pays to kind of combine the riskiest securities, be it in credit, emerging markets, securitized, with duration. And that tends to pay off over time because those are not perfectly correlated with each other.
So if high yield's in a sweet spot, investment grade, the story that we got this morning, has delivered 11% over the past 2 months. So it's had the best run in nearly 20 years. I just wonder where you're left for sort of really, really exceptional return, like MBS or leveraged loans. What proportion would you be prepared to take on the left and the right-hand tail if I looked at it in that perspective? MBS, leveraged loans. If everything else is in a sweet, sweet spot, what's left behind? What's lagging? What should I look at?
I actually don't think, we might actually have a more boring market than you think in 2024. Despite all the volatility we might see, I think we wake up at the end of the day, 2022 was a market where everything had horrible returns. 2023, almost everything had great returns. You mentioned investment grade. That's almost all the duration rally we just saw. I think 2024 is setting up to be more of a coupon clipping year. Maybe you get a little capital appreciation, you lose a little bit from defaults, but I don't see big differentiation. And look, if people are looking for 15% return in fixed income, they ought to look elsewhere. That being said, we don't see anything disastrous on the horizon. So you should get kind of mid-single digits from, fixed income as a whole.
Very, very briefly, we're talking about a global bond market rally. We've had a little bit of a joshing on the show in the past couple of days, is that there is nothing, Tina, there is nothing else as opposed to the US bond market. But if you had to choose a bond market overseas for full return next year, for a good return next year, what would it be?
Look, I think it's possible we get it in Europe since we didn't have as much of a duration rally there. I think on the credit side, valuations are slightly more attractive in Europe than they are in the U.S. today, although, the economic picture is not as rosy.
No.
I know I'm disappointing you. You like to have some provocative stuff. I don't think there's any region of the world. I would recommend that investors, if they're going to invest in the bond market, should do so on a global basis, but it's always important to remind investors that when you invest outside of the United States as a U.S. investor, there's no reason to take the currency risk on. You should do it on a hedge basis.
Do it on the hedge basis. We got you. And then that, of course, comes down to the conundrum of where does the euro go by the end of next year. Could go to parity. One call this morning. Gershon, thank you very much. Gershon de Stenveld at Alliance Bernstein, our guest this morning on the bond markets. And if you are just joining the show, this is what we've got. Wow, ladies, it's just turned red. 48, S&P 500 is at 48.3025, down 0.7%.
Yeah. It's just
a
kind
little
of
bit of
tortured.
action.
A little bit of action, but it feels a little tortured.
A little tortured. I mean, again, we'll see how the cash trading session goes, but we are very, very close. We are a whisker away from that all-time high. We'll see if we get it by the end of 2023, or whether this is a 2024 conversation, if this is a 2-year drought for the S&P 500 when it comes to all-time highs.
Or do investors think about it tomorrow, last day of trading?
That's true.
For 2023 and come in.
I think Gershon made a very valid point in terms of this. It is one of our lead stories this morning. It is about a global bond market rally. Is there any sense of exhaustion? No, not so much exhaustion, but perhaps the pace and the speed with which these bond yields trade to the downside perhaps just slows down. And there is this growing doubt that you're going to get 6 rate cuts from the Federal Reserve going into 2024. Another bond auction tonight. Is it 7s or 5s?
It's 7s.
7s tonight, because we saw
Mark your calendar.
Quite a big move in the 5s and 30s yesterday, and 10-year bonds down by 10 basis points. So these last auctions have not caused the indigestion. Nearly $10 trillion of government debt will be rolled over next year. That's your indigestion. That's a big piece of turkey.
I know, yeah, a big chunk of change. We'll see how that's taken down. And I don't know just how the Fed is thinking about everything. You talk about the balance sheet. I think that's going to be more of the conversation next week.
I do wonder, too, how much has been pulled forward in terms of expectations of what we're going to get from the U.S. central bank and other central banks. And then if that doesn't happen, then what's the correction that we see ultimately in 2024?
The big thing that we've had this morning is, of course, Cathie Wood was with us. We touched on AI. Where do we want to be in the AI conversation? We will continue that narrative with Fred Havemeyer. He joins us very shortly.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
Great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
In our private portfolios, we are already exposed to Anthropic, which has been a major beneficiary of the drama around OpenAI that we all witnessed a few months ago. We are so impressed at how OpenAI has led the industry. We're also impressed, however, at the open source models, and we'd like to encourage more of that movement.
Cathie Wood, a little bit earlier with us on surveillance, the CEO and the CIO at ARC Investments. And it was a good conversation, a broad church, everything from the macro. We didn't quite get her rate call from her, but she did say, should be at 2% in the US. The models suggest that it's unlikely we're going to get to that level, but we're still a little bit too high, obviously, as where the market's even pricing in 170 basis points. It's still probably a bit too rich for Cathie.
And she has been concerned for a long time about the Fed overdoing it, and concerned about the impact that would have, and what that means in terms of a deflationary environment. Like, just
she liked deflation for tech.
Yeah,
I would imagine so. Yeah, you know, something else we didn't get to as well is China. And we were saying this, it feels like never enough time with Kathy Wood, but we did get to AI, of course, one of the dominant market themes, particularly in the tech sector, which is really where she finds her home. And I would imagine it's going to be dominant in 2024 as well.
I would say it's inescapable. Let's take that conversation to Fred Havemeyer. He's the head of US AI and software research at Macquarie. Fred, let's just step back for a moment. The headline this morning is that the NASDAQ 100 is heading for its best year since the dot-com bubble, up 55%. That's if we go to the close on that. How much more AI, how much more flow of money do you expect to see into the AI space in 2024? Or is there any hint at all that perhaps we have expended a little bit too much energy in the Magnificent Seven? Good morning.
Good morning to you too, and thank you very much for having me on. I think that going into 2024, AI, generative AI specifically, is the key theme that we're highlighting. It's the number one of the 4 themes that we're looking at to drive investments in 2024. And we think that going into this next year, that this will be the first year that we're seeing really strong material signs that enterprises are adopting generative AI. And so we think that there is room here for these companies like OpenAI and Microsoft through its Copilot partnership, or rather its Copilot products in partnership with OpenAI, to really begin to materially monetize on generative AI through commercialized and enterprise-focused products. So we've taken a look at this ourselves and tried to look at the revenue and profitability opportunity, because at the end of the day, we're trading on fundamentals, not just hype in the AI cycle here. And we estimate that Microsoft, in our base case scenario, can generate about $9.1 billion of sales by the end of fiscal year 2026, which is the, of course, calendar, or rather the year ended June 2026 for Microsoft. And that this corresponds to about 49 cents of EPS uplift for the company, just on the back of generative AI copilots, which we don't believe is priced in at this point. So considering that we're already beginning to look at companies 2 fiscal years out, looking into calendar year 2025 and even fiscal year 26 for many companies, we think that there is upside here to fundamentals that we don't see priced in. So when we look a little further into this whole landscape, we recently introduced our new generative AI thematic bucket, trying to look at those companies that we think will benefit from enterprise spending on generative AI. We've assembled a group here of companies that include Microsoft, ServiceNow, Salesforce, MongoDB, CrowdStrike, HubSpot, and PowerSchool, which we think are all set up to actually benefit from incremental and new spend on generative AI products this next year.
Is it, Fred, generally the folks that are involved in kind of the backbone of creating AI, that's the play you want to do, since we don't really know exactly where it's going to lead to productivity or benefits financially for individual companies?
You're quite right. I think we have a bit of a diversified approach here, trying to look at the companies selling the picks and shovels, the companies with access to, through like Microsoft's partnership with OpenAI, the foundational models, as well as the infrastructure. But we also think that there is opportunity here for businesses to begin to materially monetize. If we look, it is early days, admittedly, but if we look at companies like ServiceNow, last quarter they called out that they had 4 significant deals signed on the first day that their new generative AI products were actually available. And we've seen also Microsoft, we estimate that they're, as of last quarter, generating about $1.6 billion in annualized revenue related to generative AI products, not copilots. That was pre-Copilot, Microsoft 365 Copilot. So it is early days, and we're watching carefully to see where productivity uplift might emerge, but we're really optimistic about where this is going to go next year.
So the picks and shovels definitely in focus. I want to switch gears a little bit, because there was an interesting news story breaking yesterday that the New York Times is suing Microsoft and OpenAI for copyright infringement, basically alleging that it's using its contents to help develop its AI services. And I'm wondering what you make of that. And is this basically a sign of what to come when it comes to lawsuits over AI and copyright?
Well, we've consistently thought and argued that copyright will ultimately really define how the generative AI ecosystem may evolve, because many of these models are trained on crawls of the public web, which in many cases contains various different amounts of data, which may or may not have new copyright concerns emerging. So we've consistently believed and argued that hyperscalers like Microsoft are some of the best positioned to navigate this, either through their ability to mount various different legal defenses, or simply through their ability to have very deep, well-capitalized pockets and networks to potentially strike data licensing agreements.
But that's a legal, you know what? That's a legal argument, and I get it, right? They have deep pockets, but I do wonder, we talked about this earlier in the week, about the regulatory oversight and figuring that out. We've learned in a rough way by not having kind of the regulatory barriers, if you will, when it comes to social media. So I do wonder, this is a big issue because generative AI gets smarter, right, Fred? By the amount of information, the data that gets into it. That data doesn't necessarily belong to a Microsoft or an OpenAI. So will regulators have to come in and kind of figure that out? Is there some royalty that gets to the data providers?
So it's something we're watching carefully, and really to the point of this new lawsuit, the New York Times filing its complaint against Microsoft and OpenAI, we think that this is going to be the lawsuit to watch, actually, to determine how courts begin to understand the concept of copyright in the era of generative AI. Then to your point on regulation, we're still in a bit of a frontier here in terms of regulatory oversight of generative AI. The White House, with its executive order on AI regulatory, on its own AI regulatory framework, we're now just beginning to see the follow-up to that, with various different federal organizations implementing what the White House mandated. I think to the point on copyright, though, the EU has been, with its AI Act, really taking more strides in that direction, also mandating companies who are producing these models to have an auditable understanding of what copyrighted data went into something, into the production of a model. And I think it goes to the big picture of what we're actually saying is a potential new risk and source of volatility in 2024, which is that with abundant generative AI, either available through commercial means or just downloaded on one's desktop, we think that there's a real risk as we go into the 2024 election cycle of new AI-driven propaganda and deepfakes becoming a really significant societal problem that could also present new points of volatility and risk this next year, and will almost certainly require new ways of understanding and regulating.
But that takes
AI.
us to one of your biggest concerns for next year, which is you talk at cybersecurity. I mean, I know we have geopolitics at play here. We're at two hot wars, but you say the landscape has shifted from unfavorable environment in 2023 to a highly hostile environment in 2024. So there's that hostility probably in the election, but what I'm really trying to get to is, you know, how do I position around that scaling up to a highly hostile environment from an equity exposure point of view? The politics of cybersecurity, we can talk another day, briefly.
Well, from our point of view, CrowdStrike and Zscaler are your picks in that space. We're choosing best-of-breed software companies, and we want to have exposure to both the endpoint security market, which is going to be one of your most critical and last lines of defense, as well as network security, and incrementally and especially real-time risk analytics, which is what we think we get through Zscaler, in addition to CrowdStrike. But big picture here, why do we think it's increasingly hostile? Well, we're certainly seeing various different dynamics. And one point we called out that we think is fascinating into 2024 is that really the digital world and the physical world appear to be converging incrementally throughout 2023 and going into 2024. With the emergence of cyber criminal organizations that appear to be engaging in more cartel-like activity.
I'm terrified. I'm just terrified listening to you. I'm just going to say, we've got to say goodbye, though.
Yeah. Well, on Zscaler, you've got a 244 target on that. That's Fred. Thank you so much for joining us this morning. Coming up on the U.S. Market Open, we've got Mona Mahajan of Edward Jones joining us with her views on the markets.
I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
It's a special edition of Bloomberg Surveillance alongside Carol Massa and Katie Greifeld. Very good morning. I'm Manus Cranny. We're moments away from the start of your cash trading session. What you can see here is the S&P desperately trying to hold on to some kind of movement this morning. There is the opening bell. It is the NASDAQ that remains resplendent. S&P 500 for the year up over 23%. But the NASDAQ is going to take that banner up 55% for the year if we close out on time. We're still just shy of that record high in the S&P 500. The euro-dollar trades at 110.92, again down an eighth of 1%. The dollar is slightly better bid this morning, and crude down 1.2% now as we see the inventories at Cushing rise for the 9th week in a row. The API inventory is up 1.8 million barrels, but there we go, a little bit of a bleed on rates. Rates higher this morning at 3.82%. We've had a couple of pretty good auctions this week. How will we get away with the 7-year auction tonight? 5s and 30s dropped by 10 basis points yesterday, and again, we are just building into that narrative of peak Fed. A very good morning. Abigail Doolittle is alongside us with the open and the movers and the shakers.
Well, it's interesting that we do have some movers and shakers beneath the surface, given the fact that the surface is barely moving. Let's start out with what is working this morning, and starting out with the shares of Altice USA. They are popping up 33% this month into today. This is billionaire Xavier Niel is interested in buying Altice Portugal. Reportedly, that's another entity backed by Patrick Drahi. In addition, earlier this month, there was a report that they may unload Cheddar to a PE firm, so a big rally there for that stock. Penn Entertainment, HG Vora Capital Management has revealed an 11% stake. I believe they have a greater than 18% overall economic stake, including swaps. They're seeking board seats. They've met with management and believe the casino company is deeply undervalued, given the fact that it's down more than 40% or thereabouts over the last 2 years, down 15% this year. That could be one reason. And then Tesla up a third day, despite the fact that China's Xiaomi has revealed its first EV. They have a goal to be a top 5 EV maker within 20 years. There's also chatter of an India factory announcement to be revealed soon. And again, we were talking about it yesterday, one company that's up more than 100% on the year. Wow. To the downside, though, let's take a look at what is weighing, and that is the crypto space. If it's still down, yes, we have some weight here with Bitcoin down more than 1%. But before we feel too badly for these stocks, let's consider the fact that on the year, speaking of a casino, up more than 350% each of them. Marathon, this is crazy, up 800% on the year. If only we had known at the beginning of the year.
if only, right? What does John Authors call it? Hindsight capital?
Yeah, something like that.
Hindsight capital here.
Always outperforms.
Love it.
Yes, always.
I am glued to the S&P 500, 4790.
You're waiting for the red headline.
We're about 6 points away, right?
Oh my God.
TikTok. We've got two sessions left to go. Abigail, good to see you this morning. Thanks for the roundup. Abigail Doolittle there with the very latest on the equity movers. Mona Mahajan is standing by, senior investment strategist over at Edward Jones. A very good morning to you. The Nasdaq's up 55%. The S&P is desperately trying to make a new record high. Do you think we're going to shift a little bit more aggressively into the new year to a full bull mode, or will there be, a bit of pulling back once Powell and the other Fed members get into jawboning mode in January? Good morning.
Yes, thanks, Manus. And certainly you've brought up probably one of the key points that we've been thinking about in recent weeks. Now, look, certainly this has been a phenomenal, probably 8 weeks or so for the S&P 500. And you have to kind of, you can't ignore the fact that the nature of this rally has shifted a bit. You know, we started the year really driven by that Magnificent Seven, a large cap technology trade. And over the last few weeks, we have seen a broadening of participation, whether it's value cyclical parts of the market, whether it's small and mid cap parts of the market, whether it's bond markets, all of which have played some catch up in recent weeks. We think that's a healthy sign. Certainly a lot of ingredients came together to kind of drive this rally forward, and that included not only inflation moving lower, but a Fed that told us they're likely to pivot next year, and of course, bond markets and bond yields that moved substantially lower. Now, to your point, as we head into the new year, one, we know markets can't move up in a straight line indefinitely. And two, you know, you give the markets an inch. Fed talked about 3 rate cuts. They take a mile. Markets are now pricing in about 6 rate cuts for next year. So we do think as we head into the new year, there could be some sparks and bouts of volatility, especially as the markets and Fed go head to head on this. And we do think the Fed will push back. Keep in mind, the first Fed meeting is January 31st. There will be speakers between now and then as well. We think they do take that opportunity to push back on the 6 rate cuts that have been priced into the market. Our view is we probably still get 3 to 4 rate cuts next year, but they don't start until later in the year, especially as the Fed does want to see that core inflation number move lower from 4% to probably sub 3%.
A lot can happen in a month before that first Fed meeting. Having said that, I do wonder, Mona, how we've been spending so much time this week. It's kind of quieted down, but we've been watching very much what's going on geopolitically. How does that potentially complicate what the Fed needs to do here?
Yeah, you know, look, it's been an interesting year in geopolitics, and certainly one way that has manifested is through the oil and energy markets. And certainly when the Israeli-Gaza conflict first hit, we saw an immediate move higher in oil prices. And we've seen since then a real cooling in oil and energy. And perhaps part of the reason is, one, those players alone are not substantial oil producers. But two, maybe there was this hope building that the conflict would not escalate. And so we did see an easing in oil and energy prices. Now, that is probably the closest asset class we're watching as geopolitics unfolds in 2024. Our hope is that the direction of travel does continue to go towards de-escalation rather than re-escalation, and that would be positive for stability in the oil and energy markets. So it's something we're watching closely. Certainly the Fed will be watching it from an inflationary perspective, especially as oil and energy plays a key component of headline inflation. But as we think about volatility heading into the new year, for those investors that hadn't quite participated in this last few weeks, we would say any volatility really provides an opportunity for investors to get involved and position for potentially a continuation of this broadening of market participation.
Also important to the economy is, of course, what the consumer does ultimately. We still see a relatively tight labor market. Having said that, we got to read on weekly jobless, a little bit of an uptick, certainly in today's, but we talked with Lara Rame earlier, who talked about companies still holding on to their workers. They want to do that. Can the consumer, as we talked earlier, moving from FOMO, fear of moving out, to JOMO, joy of missing out, maybe they've got bills to pay and they're going to hold back. Can the consumer continue spending in the new year?
Yeah, it's a critical question, and I did hear the JOMO phrase, and I loved it. We also are in the camp that the consumer is facing some headwinds heading into the new year, and keep in mind, we are coming from a very strong position of strength from Q3 of this year, where GDP growth was 5% nearly, and consumption was 4% roughly. And so from that high level, do we think there could be a potential for a slowdown? Yes. Keep in mind, for the consumer, excess savings have been worked down. We are seeing still elevated interest rates, mortgage rates, despite the recent cooling. And of course, bank lending standards remain tight. Credit card debt, as we know, is moving higher. And we're seeing some early signs of delinquencies as well. So all that being said, some challenges facing the consumer as we're heading into the new year. But we know the U.S. consumer likes to spend and does does and can remain resilient in the face of some challenges.
The U.S. consumer will spend right to the very end, the last consumer to put their credit card away.
Hard to bet against the U.S. consumer, but I want to bring this conversation back to the markets because you mentioned participation, and something that we've been talking about all week is that $6 trillion that's sitting in money market funds right now, and many a bull case has been built on the idea that basically you'll see that cash come out of money market funds and venture into risk assets, venture into equities and fixed income. Is that your view as well, or maybe a little bit of caution around that one?
Yeah, we do think that part of the money that has flown, and it's been a tremendous inflow, you mentioned the $6 trillion figure, into CDs and money markets. We think some of that money now is starting, as CD money comes due, as investors are thinking about reinvestment risk, we think there is a case to be made that the money that maybe would have flown into your CD and money markets will now start to flow into more traditional asset classes like equities and bonds. And certainly there's a couple reasons for that. One, of course, as the Fed is potentially embarking on a rate cutting path, we will have reinvestment risk. Two, there is an opportunity cost to sitting in cash, and hopefully investors are starting to see with the S&P up 25%, but even the bond market rallying close to 5% in recent weeks gives you a run for your money for traditional cash assets. And then thirdly, over time, over any 30-year period, we have seen historically that cash has been a lag class. So sure, as we are thinking about our portfolios, that we're not too overweight cash and cash-like instruments, and we're strategically, allocated so that we can kind of meet and exceed long-term investment returns. And we do think this year in particular will be a great one to complement. We understand the reasoning to get into these CDs. Rates are higher than we've seen in recent history, but that could start to be trending downwards, and good time to start thinking about complementing CD money with traditional equities and bonds.
Well, just to sit with this thought a little bit longer, the pushback to that argument, basically, that you're going to see cash come off the sidelines that we've gotten is that you think about that $1 trillion that's come into money market funds just from March, of course, and the banking struggles that we had then. Maybe that's going to be stickier than usual, that it won't be, this additional fuel that for equity markets and risk assets that maybe we've seen in the past. What's your thinking? Does that hold water with you at all?
Yeah, I do think we are going to see a different portfolio construction in the next, call it 5 to 10 years even, given that Fed funds rate are likely not to move back to the zero bound. So you're probably looking at a Fed funds rate over time of 3%. And so in that environment, Treasury yields are probably somewhere between 3 and 4% themselves. And so this idea that you had to be all in equities or all in growth even probably doesn't hold over the next several years. So we think there's better balance between your equity and bond portfolio, and there is more room for cash-like instruments that are yielding attractive values. And so we'd say is make sure that you are thinking about not only equities, but think about investment-grade bonds to complement some of that money market cash-like instruments. So we do think there is a place for cash and CDs, but we think that it's important to think about investment-grade bonds. Not only are you locking in some of those better yields for a longer period, but you get the potential for appreciation if yields continue to move lower as well. So great kind of alternative.
Just on those investment-grade bonds, just briefly here before we go, is that perhaps an alternative to equity exposure in the Mag 7? If you want to diversify more broadly away from Mag 7 on the equity side, can I look at the IG bond side of the Mag 7 as perhaps a slot on the board that the IG component makes up?
Yeah, that is a very interesting call out, and I do think that's a way to play it as well. If you're thinking about some of the growth parts of the market and want to play it from the bond perspective, these are the companies that are very cash rich, that will probably make good on their investment grade bonds, and they will likely not often need the bond market to raise cash. So when they do, it's a great opportunity for investors. So we would say, investment-grade bonds in the Magnificent Seven or broadly in the technology space is a great way to complement your portfolio as well.
Mona, thank you so much for being with us this morning. Let's see what
thank you guys.
Let's see what the start of
holidays.
2024 brings for us. Happy holidays from all of us. Mona Mahajan there from Edward Jones. And if you are just joining Bloomberg this morning at 9:42, this is what you have got. The S&P 500, 4790.51. We are up 1/8 of 1%. What's the number?
Just below 4,800.
Well,
not 47.96, which would make it a record. 47.96.56. It's got to go above that.
6 pips away.
What did you say yesterday, that you could just about smell it?
I can smell the weekend, right? Which is
smell a new record.
Another phrase. Another phrase. Yeah, why not? I mean, will you get 55% and 23%, 55% on the Nasdaq? Will you get 23%, 24% on the S&P 500 next year? You're probably going to need an awful lot of work from the Fed to get that.
It keeps popping. It keeps hitting like 47.90 and then just backing off. So, you do wonder, again.
You're going to need a little bit more fresh money to come in to take that up. Coming up with the team, Aaron Kennan of Clear Harbor Asset Management can help us understand whether we can take out some of the records. That's coming up next, right here on Bloomberg. Good morning from New York.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?